You may be an investor, you may be a business owner. So don't just be a business owner, investor, or a T4 employee with an organization. Also start thinking like how you can be a banker and how becoming a banker would enhance everything that you're doing financially.
I'm going to put in an investment. I'm going to put in a GIC. Sure, you can earn $100,000 off that investment, but the government has designed a specific tax rule where those passive income inside a corporation will get taxed at 50%. But by you storing the capital in a properly designed policy like what we do, that bypasses the tax.
Welcome and congratulations for being here and investing in you. My name is Dan Allen, and I'm one of the team members here at Ascendant Financial. And we're the best when it comes to the infinite banking concept and teaching it to others. You're all familiar with the process of banking. You just don't control it. We're going to dive into that subject, so be prepared for the journey. And next, and you would have heard him at the Wealth Genius event, Sarbloh Gill. Now, Sarbloh's ability to help others see how simple this process is and how it could make a difference to them is simply amazing. And with that, over to you, Sarbloh.
Now, the agenda today is pretty simple. So we're going to touch base on the talk that we did at Niagara Falls. So there's going to be a little bit of recap because from our experience, repetition is going to be the best practice. The process of becoming a banker is not complicated. It just needs a little bit of education. So we're going to do a little bit of repetition. We're going to spend about 15-20 minutes just talking about what we covered at the Niagara Falls talk so that we all have the same foundation again. And from that foundation, we can build into the case studies. And you're going to love the case studies that we have for you today. So we're going to talk about car financing. We're going to talk about real estate investment financing. We're going to talk about a very amazing strategy called debt recapture, which is going to blow your mind. And then my colleague Henry is going to talk about how to keep taxes away from your wealth. So as investors, I'm an investor myself, and most of my colleagues here are building wealth also in investments. As we invest, we create more wealth for a family, but at the same time, with that, other problems also come, which are, it's a good problem to solve, which is taxes. So we're going to talk about how to keep taxes away from wealth. So let's do a quick recap on Niagara Falls talk. So we talked about, the Ascendant Financial. We're headquartered in Edmonton, Alberta, but we work coast to coast. We serve Canadians coast to coast. We are on a mission of educating and empowering North America now, not just Canadians, on the process of becoming a banker, the infinite banking concept by creating their family bank. Nelson, he's the pioneer and founder of the process of becoming a banker. So if you haven't had an opportunity to read Nelson's book called Becoming a Banker, the Infinite Banking Concept, I mentioned this at the event in Niagara Falls. Please get yourself a copy of the book. It'll be an amazing addition to your library. So Nelson always used to start his talk by saying everything begins with the way that you think. And here's another fact about thinking. Most people would rather die than think. Thinking is the most important thing, but thinking about how we think is even important. So I would like to encourage everybody to start thinking like a banker. You may be an investor. You may also have a T4 job. You may be an investor, you may be a business owner. So don't just be a business owner, investor, or a T4 employee with an organization. Also start thinking like how you can be a banker and how becoming a banker would enhance everything that you're doing financially as you go through the presentation today. Now let's follow the flow of money. Money is just a commodity. It's a tool that's required to buy the things that we need. So to do that, money has to flow. We have to exchange money for the things that we need. So if this is you, let's just say you have a mortgage payment today. So you making a mortgage payment, and then you have a car payment, and then you have credit cards and lines of credit, or you're buying appliances for your house or investment properties. You're doing house remodeling, you're buying furniture, you're taking families on vacation, you're buying clothes, you have property taxes to pay, you got boat payments, you have healthcare plans, you got investments, you got medication, you got charitable cause donations, you got chiro and physio expenses. So you are doing all the work to pay for all those things. So you're doing all the work to earn the money, but when you make payments for all the things that you need in life, the money is flowing away from you. Those flow of money away from you are liabilities because it's away from you. We're going to talk about how you can make those payments assets also. If we look at all what you're doing today when it comes to the use of money, and you know your situation better than anybody else, if you think about all the income that you're earning today and all the money that you're spending on the things that you need money for, and if you ask yourself this question, after adding all those payments, how much of that money do you presently have And the answer is zero, because all that money is flowing away from you. Again, you're doing all the work, someone else is getting all the money. And that's the problem that we're going to solve today. And the reason why that is happening is because you're familiar with the function called banking, is you're just not controlling it. Becoming your banker is all about creating your own private family banking system so that you can control 100% of your banking/financing needs. And if you do that, then all those payments start to flow back towards you. So you're still able to accomplish the objective of use of money for buying the things that you need to buy, but you're going to change the direction of flow of money, which comes towards you versus away from you. All those things that you buy become your assets, because the asset was not the real estate, the car, the investments. The asset is that, as a banker, is a stream of payments. To have the money flow towards you versus away from you. And if you can do that without working any harder, without changing your cash flow, without taking any risk, and certainly without ever losing control of your money, won't that be worth it? So give it your close attention, and it can make a radical improvement in your financial future. And here's the fact. There's two ways that you presently are flowing money, and you have to use money to buy the things that you need to buy. And the two ways that you're presently flowing money is either you're paying cash, and paying cash doesn't mean you have to carry physical cash to buy things. Paying cash also means electronic debit transaction. That is equivalent to paying cash. So when you pay cash for things, you're using your money. That's one way for you to use money. The other way is you borrow money, which is OPM, other people's money. And these are the two most common ways that most people go about buying things that they need in life. Now, it doesn't matter which of these two methods you use. So if you use pay cash, which is debit or physically using cash, I call that the lose interest transaction, because when you pay cash, money is gone. It's gone over your lifetime. You're not going to earn any interest on it. You can certainly not use it again. So paying cash is lose interest. And when you talk about borrow money, which is using someone else's money to accomplish the objective, then you're paying interest. So either you lose interest or you pay interest. And it doesn't matter which of these methods you use. Both of these methods involve a permanent transfer of money away from you forever. And it's not just gone over your lifetime. It's gone over the life of generations to come. The loss is permanent. And this is how I can best describe it. Now, we talk about paying interest, and then we talk about losing interest. So a debtor is an individual who always uses borrowed money. Now, let's just say this black line on top represents zero cash, zero wealth. Now, the objective is to get into positive. So if debtor is always borrowing money to use someone else's money to buy the things that they need to buy, yeah, certainly they're able to accomplish the objective of using someone else's money to buy the things. But because they're debtor, they go into negative because they go into debt. And then the debtor has to start making back the payments on someone else's terms. And once the payments are made back in full, yeah, they've accomplished the objective of use of money for over that transaction. But now, how much money do they have on that transaction? It's zero. And then when they're ready to buy the next thing that they need, and again, they have to go into debt. So they go into debt, they make those payments on someone else's terms. Once the payments are done, again, the objective of accomplishing the use of money is done, but all that money is gone and they have zero to show for it. Now, debtor always knows how much interest the debtor has to pay because it's in the loan contract. The lender would stipulate the interest rate, the payments, the amortization. So debtor knows how much interest the debtor has to pay. Now, saver is an individual who says, I don't want to pay any interest because I hate interest. It's going to cost me. So what I'm going to do is, for everything that I need in life, I'm going to use my cash. Now, to use cash to buy the things that the saver needs, first thing that the saver has to do is to do the obvious, which is to save cash. So they start at zero, they start saving cash. They start saving cash, and all this money is saved maybe in checking account, in savings account, which is someone else's bank. Doesn't matter which bank. It's someone else's bank. It's not the saver's bank. The moment you deposit money in a bank, you just become an unsecured creditor to the bank. That money is now bank's money. It becomes available on demand when you ask for it, but now that money is actually bank's money. As the saver starts to save money in someone else's bank, and once they reach a certain point where they have enough money saved, they take all the cash and then go buy it. But then again, they accomplish the objective of buying whatever they need to buy, but all the cash is gone. And then they restart the process again by saving capital again in someone else's bank. And once they reach a certain point, they take all that money and go buy whatever they have to buy. Again, they accomplish the objective of buying it, but all the cash is gone. Saver sees a transaction in a way that, yeah, I'm accomplishing the objective. See how much interest I'm not paying because I'm not borrowing money. But what saver doesn't realize is how much interest the saver is actually losing when saver pays cash, because this money could have been earning interest for the saver. So when we pay cash for things, we make a decision of not to earn interest, cost of loss opportunity. So whether we borrow money as a debtor and we pay interest, or whether we use money as a saver and we pay cash, we lose interest. Both ways, we're making a financing decision. Every decision that you're presently making when it comes to the use of money is a financing decision. You're either losing interest by paying cash, or you are borrowing money and paying interest. Either ways, it's a financing decision. What you're going to discover today using Family Bank, that this is a better way to finance the things that you need in life. And every decision that you're going to make when it comes to the use of money in future will be financing. The question is, how much of the money are you going to retain? The problem is never the problem. The problem is how we think about the problem. So here's the problem. Whether you're debtor, whether you're saver, you're able to buy the things that you need in life, but all the money is gone. You're doing all the work to earn money, and everybody else is getting your money. That's the problem. Money is being permanently transferred away from you and your family. And the solution is the Family Bank, the process of becoming your own banker. And it's a solution because it helps you recapture the interest. So paying cash is losing interest. Borrowed money is paying interest. The process of becoming your banker helps you retain your cash because it's a process of recapturing interest. And we're going to talk about that all day long today. Recapture interest. Let's say you today have money in a GIC. So GIC stands for Guaranteed Investment Certificate. So as someone puts money into GIC, over the term of GIC, you're not going to lose money. That's basically what it is. It's contractually guaranteed to earn that interest over that term. So let's say you have $30,000 and it's in GIC and it's earning you 7% per year. So it's compounding once per year. And then you have the need for use of $30,000. We always need more money, right? So you have the need for use of $30,000. Now here are your options. You can either use your cash. So you can actually go to the bank where this GIC is sitting in, and you can say, hey, Mr. Banker, I need money. So I would like to withdraw $30,000 out of GIC today because I need the use of money. So that's option one. The option two is you don't have to touch your GIC, let it earn 7%, but you go to a private banker and then borrow against the GIC, but by using this GIC as collateral. But the private banker is going to say, okay, well, if you need to borrow money, I'm happy to use the GIC as collateral. So I'll give you the $30,000 that you need, but you have to pay me back 12% annual interest. And you have to make that payment back to me in 4 years, principal and an interest payment. So the question is, if you need $30,000, do you want to use your cash and take that money and go use it? Or do you want to have this money sit in GIC, let it earn 7% and actually borrow against it from a private banker, but you got to pay back at 12%. So remember, you're earning 7%, but you got to pay back at 12% in 4 years. So if these are your options, so let's look at the private loan. So if someone would have opted for the option two, which is private loan, so borrow money, which is $30,000, and the interest charge is 12%. Loan duration is 48 months as stipulated by the private lender. Monthly payment would have been $790 a month. Total repaid is $37,920. So $30,000 is the principal and $7,920 became the interest. So that's the total repaid over 48 months. Let's see what would have happened in GIC at the same time. So capital in GIC is $30,000. It's earning 7% interest. Compounding duration is 48 months, so same terms. Account value at the end of 4 years is $39,323. So the total interest earned would have been $9,323 on GIC. So when you look at numbers now, you know with clarity that it wasn't a factor of the rate. I can earn at 7, pay back at 12, and still come out ahead financially. In your mind's eye, some of you may have thought, well, how would it make sense if I have to earn at 7 and pay back at 12 and still come out ahead financially? I would have lost 5%. The objective behind this example is not about, hey, go take your money and put into GIC and let the GIC earn and compound and always borrow against that from private lender. That was not the objective of this example. The objective of this example was to encourage you to start thinking differently. Don't think in terms of rates. It has nothing to do with rates. It's all about the volume of interest paid and volume of interest earned. And the other thing is, want to give you clarity on what recapture interest actually means. So in this particular scenario, interest paid to the private loan at 12% is $7,920, and the interest earned on GIC is $9,323. So if the person would have kept his GIC $30,000 and kept earning 7%, but borrowed money against it at 12%, the person would have recaptured the interest paid to the private lender on the growth of the GIC. So I just want to give an example of what recapture interest means. But again, don't buy GIC. That's not the sense of this example. It's just a teaching point to show you the power of recapture interest, and also the power that we make decisions based on rates all day long. How much is the borrowing rate? How much is the growth rate? Please, I'll encourage everybody to not make decisions based on rates. Do your math. Look at the volume of interest earned over the lifetime and volume of interest paid over the lifetime. Now, becoming a banker will help you keep your money in the family, because becoming a banker is the best way to recapture the interest going forward for the things that you're going to finance. So again, we talked about paying cash is lose interest, borrowed money is pay interest. Family bank, using infinite banking concept, is the recapture interest method. So imagine this green line, this green dotted line represents your wealth, your cash growing every single day, just like how we did in the GIC example. So think about this as that green line that's increasing in value, your cash every single day. And then once you need money, you're able to borrow against your money by not interrupting the growth of your money. And you pay back the loans on your terms, because becoming a banker is you being in total and absolute control. When you need access to money, you don't have to qualify. You borrow money, you pay it back on your terms, and when you repay the money back to your terms, you're able to recapture the interest so that you can go back and borrow more money next time, and you can keep doing this process all day long. Now, the tool that we use to implement the process of becoming a banker, as we had discussed in Niagara Falls also, is called a participating dividend-paying whole life policy. And the reason why we use this tool is because this tool has the best attributes available so that you can recapture the interest on your terms. There's no other tool that we know which can actually do that. And if you know something that we don't, we are happy to learn also. If you see an alternate to this tool in the marketplace, please share. We're always willing to learn. Now, a participating dividend-paying whole life policy has a few components. So the first thing is premium. Now, again, I want you to don't think about this as life insurance. I want you to think of this as a tool where you can put capital in and then finance the things that you need while you're alive. Since it is life insurance, it is going to have the extra benefit called the death benefit, which will come walking in when your family needs that money the most. Now, because we're talking about becoming your own banker, and to create a banking system, you have to deposit money into a banking system, no different than how you're depositing money in a commercial bank. So the premium is your deposit into your own family bank. So you decide what the premium is going to be. The moment the premium goes in, which is a deposit, it buys one thing and one thing alone, which is death benefit. And the death benefit is received tax-free by the named beneficiary upon the death of life insured. Once it buys death benefit, because it buys death benefit and because of the nature of the product, which we'll talk more about, it starts to accumulate and grow cash values. And cash value is your capital. That vests with you 100%. That's your capital. Now, the cash values increase in value every day, tax-free, because insurance company has a very unique contractual guarantee on this policy. And the contractual guarantee is that total cash values of the policy must equal total death benefit by age 100. So if you are, I'm just using an example, if you're 45 years young today, and let's just say you have $1 million in death benefit, over the next 55 years, because you're going to be age 100 in the next 55 years, your cash values will grow every single day because it has to match the death benefit by age 100. And on top of that, because it's a participating policy, by you owning this policy with this insurance company, with a particular insurance company, you become a co-owner of the insurance company. And as a co-owner, you are entitled to dividends. That's how insurance companies distribute profits. And these companies have been profitable in Canada since 1847. So the companies in Canada have paid dividends every single year. So they sold the first policy in 1847, and they have paid dividends to policy owners since 1848 every single year without a miss. So if you look at today's 2022, and then if you go back in time to 1848, that's over 170-year track record of paying dividends. Now ask yourself a question, can a business ever pay dividends if the business is not profitable? That means these companies have been profitable for over 170 years. They must be doing something really well when it comes to managing the money. And keep into account all the recessions, depressions, the interest rate fluctuations that we've had over the last 170 plus years. So I'm going to dive into breaking down the policy. So your premium, which is the first component, which is a deposit, that premium actually has two components in it. One is called the required premium and the other is called deposit option. So I'm going to use an example. Let's just say someone wants to put 10, 15,000 per year as premium deposit into their family banking system to build their family banking system. Out of that $15,000, there's going to be a small portion of money, which is called the required premium. And then there's going to be a bigger portion of the money, which is going to be called the deposit option. That's how the policy is designed to maximize the growth in the policy. I'm going to dive into a policy anatomy in a bit here. On the bottom, as you can see, this is a graph. On the bottom, this is age. So I'm assuming that this person is 45 years young. So they're starting a policy today, they're 45. And the contractual guarantee is still age 100. So in the bottom, it's age. Now, the moment they put the required premium, so again, the premium is distributed into two components, the required premium and the deposit option premium. The deposit option is optional, not required, but you're going to see how it helps build the system going forward. So the moment they put the required premium in, and assuming this is just an example to demonstrate what happens in the policy, they have a starting death benefit of $400,000. So required premium buys the death benefit. And because the premium bought death benefit, insurance company is going to start to accumulate and grow cash values, so that every single day this person ages, their cash values are going to grow to match the death benefit by age 100. So cash values must match death benefit by age 100. They started the policy at age 45. Now let's fast forward 1 year. So now they're 46. So they're 1 year into policy. Portion the premium was DO, which stands for deposit option. And then 1 year in, so they reach age 46, they receive their dividend. Dividend is paid on policy anniversary day. It's not tied to calendar year. It's tied to policy anniversary day. So today is December 10th, for example. If a policy gets started today, then December 10th every year is your anniversary day. So when insurance companies become profitable, they declare dividend, it is paid to you on your policy anniversary day. So they're 1 year in, let's just say they're celebrating the policy anniversary, and they put another required premium, they put the deposit option, but now they also got the dividend. The deposit option and dividend is used to increase the death benefit, because the logic is cash values must match the death benefit by age 100. So if we keep increasing the death benefit, then we're going to keep accelerating our cash value. So the policy is designed to keep accelerating your death benefit, because that is how we keep accelerating your cash value growth. So the deposit option and dividend, let's just say it purchased $30,000 of additional death benefit. So in this example, the total death benefit now becomes $430,000. This $30,000 is called paid up addition. Now, the word paid up meaning the deposit option and the dividend is all that's required to buy this extra block of death benefit. So that's why it's called paid up. No more extra money is required. Once this money is in, no extra money is required to maintain that extra block of death benefit. And it's called addition because it's in addition to what you already started at. So total death benefit now becomes $430,000. So the moment we buy this extra block of death benefit, it will have its own cash value, which is going to grow every day to match that death benefit by age 100. Now you're 47 years young, so I'm going to go 2 years into policy, and then they put in another premium, another deposit option, another dividend. Now here's something interesting about dividend. So as years go by, the policy owner receives dividend on every block of death benefit. So at age 46, they only receive dividend based on the yellow block. But when they turn 47, because they have the yellow block and the blue block, so they receive dividend on the yellow block and the blue block. So now the dividend that they received at age 47 is much more than what they received at age 46. So that dividend, along with the deposit option, let's assume, bought another layer of paid up addition death benefit, which in this case is $40,000, because now you're getting more dividend, which means more paid up additions. And then this will have its own cash value, which must grow every single day to match the death benefit by age 100. So you can see 2 years into policy, the death benefit has increased to 400,000 plus 30,000 plus 40,000. That's 470,000 in this example. In each of these blocks have their own cash value, which is growing and compounding. So as years go by, the death benefit increases, which is good from estate planning protection for the family standpoint. But it also starts to compound the cash values even better. Now I'm going to do another year. So age 48. So they're 1, 2, 3. So this is the third year anniversary. And now they put in another year's premium. And out of that premium, a portion is deposit option. But then now they get dividends. So they are not getting dividends just on this yellow block that they started at. They got dividend on yellow block, on blue block, and on this, let's just say, call it brown block. So now they have more dividends than age 47 and age 46. And then that dividend now purchased along with the deposit option premium, purchase another block of death benefit. And this block has its own cash value, which must increase every day to match that death benefit by age 100. And then if they continue like this, as you can see, we keep piling up the blocks of death benefit, which keeps growing and accelerating the cash values in the policy going forward. Everything gets better as time progresses. The death benefit increases, the cash value increases, the dividends increase. The only thing that would never increase is the premium. The premium stays the same. You can reduce the premium, but you cannot increase it. And reducing the premium is your decision, not the insurance companies. They cannot force us to reduce the premium. So we have family income, whether it's active income, passive income, because money has to flow. So we have family income coming in. We have family expenses. We got to live, we got to survive. We got food, clothes. We got to take care of all that stuff. So after family income, all that money that you're presently earning is flowing to the books of someone else's bank. And then when you use that money, the money is gone. What we're going to do is we're going to take that money and build a family banking system. Now I show you 1, 2, 3 banks. Most of our clients have more than these policies in their family bank, but we all get started with one. So the whole process is not about just one policy, it's about system of policies, because as your cash flow increases, as you use the family bank, you're retaining more dollars. And as you increase your cash flow, more money has to flow through some bank. So we keep flowing more and more money through our banking system because we want to retain more and more of that money going forward. You put monies into family bank and premium is what you want it to be. All that goes into family bank. And then the premiums in the family bank buy one thing and one thing alone, that's death benefit. And because you buy death benefit, because of participating dividend paying whole life policy, the attributes of the product, it creates cash values. Now, cash value is your capital. So if an opportunity comes up, you can access your own cash value if you need to use your money. And now we know that if you use your money, you will accomplish the objective of buying the things, but all that money is gone and this cash value will stop growing because you're interrupting the growth by using your own cash value. What we're going to do is we're not going to use our capital. We're going to use insurance company's capital via a method called a policy loan. What you can borrow as a policy loan is 90% of your cash value. And when you borrow capital via policy loan, it doesn't interrupt the growth of your cash value because cash values continue to grow to match the death benefit by age 100. You're borrowing against it. And when you have to borrow money, you don't have to qualify. There's no consent to repayments. Insurance companies, for participating policy owners, anybody who has a policy, everybody's pre-approved on loan the day they get started with the policy. There's no qualification. So as time progresses, total cash values must match total death benefit. So if cash value have to increase, which means your access to capital also increases because what you can borrow is always 90% of cash value. So as cash values increase, because it has to match the death benefit by age 100, your access to policy loans increase. And every year, as I just demonstrated, your death benefit increases. And when death benefit increases, your cash values increase, which means your policy loan access to capital also increases. Now, it doesn't matter what happens in the financial world outside of these policies, the cash values keep increasing every day because it has to match the death benefit by age 100. So stock market goes up, cash values will go up. Nothing to do with stock market, but because it has to match the death benefit by age 100, cash values will increase. If stock market goes down and commits a suicide by jumping off the Mount Everest, your cash values will still go up because of the contractual guarantee. If crypto goes up, cash values will go up. Again, cash value increase has nothing to do with crypto, but the reason why the cash value is going to increase is because it has to match the death benefit by age 100. If crypto goes down, cash values still go up. Interest rates go up, cash value go up. Interest rates go down, cash value go up. I think you get the teaching point. Now we're going to dive into family bank, and we are so excited to share with everybody 4 very specific family bank case studies. And each case study is different, and the objective is to really empower you with the opportunities that the family bank has. Nelson called the process called becoming your own banker infinite banking concept. Now, the reason why he used the word infinite is because we cannot put boundaries around infinite. It's limited to your imagination. So we're going to showcase 4 different ways of using it, but how it's going to work for you is based on your particular circumstance. So connect with us, have a discussion with us as to how this family banking can be set up for you. It'll be one-on-one meeting, and these family banks are customized to your goals. So becoming your banker is truly about becoming your own banker. So each family bank is unique. Each family bank has a unique design because each family goals are different. So how it's going to be designed for you, it's based on your goals, how you structure the different income, assets, liabilities. It's not one size that fits all. So the family bank goals. So here's most of the clients that use the family bank for. So first thing first is investments. They want to build wealth. So I call that multiplication effect. The other is debt recapture. So you may have heard the word debt elimination. People don't come to us for the purpose of a debt elimination. They can do that on their own just by increasing their payments on the debt. They come to us because they want to change the things that they are doing presently financially so that it improves the financial outcome for the family. So they come to us for debt recapture. So if you're not familiar with the debt recapture concept, stay tuned. We're going to walk through a case study. And if you're sitting down, you'll be glad you did because it's going to blow your mind. So debt recapture, that's going to eliminate debt. And then they also use the family banking for, purchasing family comfort, cars, vacation, children's education, property taxes. All those things have to be financed. So they finance it from the family bank. And then you're going to also learn a different way of keeping taxes away from wealth, which is the most important use of the family bank. And I call this generational because it applies to generations to come. Keep taxes away from your wealth. The first case study is on flipping for cash. So before, after. All right, so I call this a tale of JV partners. So meet Philip and Manish. Now, Philip is an engineer. Manish is a project manager. That's why they make amazing JV partners, because they have the same thinking mindset. Now, they were both very similar in age when they introduced to each other. So Philip was age 38, Manish was age 39. Philip was also married. His wife is age 39. Manish had a spouse. She was age 36. And Philip has a daughter, age 3, and Manish has a son and daughter. So daughter is age 6 and son is age 1. So they're JV partners. They have their full-time jobs. They do also a lot of investments in real estate, and you're going to see what kind of investments they buy. So they've been investing in real estate since 2012, mostly all joint JV partner deals. The good thing about them when they met with us is it's just the amazing mindset that they had. They were coachable. They wanted direction using the family banking from us. They're always willing to learn. They discovered the infinite banking concept, the family bank, in 2016 after reading Nelson's book. And then here were some of the meeting facts on 2016. Now, when we met with them, they had no life insurance. The total debt, so they had some properties that they had bought, and then they were holding those properties for the purpose of cash flow. But again, we had to rely on banks for the purpose of buying properties. There's only so much money that we can save in a year. So the remaining money to buy the properties comes from the bank. So they had about $1 million in debt that they owed the bank. They had, I think, 2 or 3 properties at that time, which they had purchased using bank's money. Now, Philip, his annual income at that time was $120,000. Manish, his annual income was $130,000. Already, they had generated about $20,000 in passive income investments through real estate, through holding properties, to doing some flipping. So they were actually doing pretty good just from a passive income standpoint between the two of them. The real estate investment goals, so they're flippers. So they flip a lot of properties. They have a great team of contractors that they work with. They also do some buy and hold for cash flow standpoint. They've done some BRRRR also. It's a combination of both. Their main goal, I haven't met anybody who doesn't resonate with this goal, is to achieve cash flow confidence and quit the 9 to 5, quit that rat race. So now here's how the IBC journey started. So first thing is always family protection, because again, nobody has a lease on life. We all have our best before dates. We just don't know what that date is. So protecting family is important, and it was important for Philip and Manish also. So because they had $1 million of debt outstanding, so to protect the investments, protect the family, what they started was a term life insurance on each other. So Philip started $1 million of term life insurance. It was a 10-year term because they were looking at being partners for at least 10 years. And after that, if they wanted to go separate ways, they have that option. So Philip owned $1 million of 10-year term insurance. For those who are not familiar with term life insurance, so term life insurance is basically a life insurance over a duration of that term. In this case, 10 years. The premiums are not going to increase for 10 years, but after 10 years, the premiums will go up. So it's like renting insurance. It's not building any asset. It's not building any cash value. It's just renting insurance. Term insurance can be much cheaper today, but as we age and as we continue to keep this term for a long time, let's just say we renew this every 10 years and the premium becomes very expensive. So Philip started with this policy on Manish. So he paid the premium on a policy that he owed on Manish. And the premium was $416 per year. The beneficiary of the policy was Philip. So God forbid something was to happen to Manish, the death benefit will be paid to Philip. Now Manish also started a similar policy on Philip, same death benefit, $1 million for 10 years. So Manish was the owner of the policy. Philip was the life insured. So something was to happen to Philip, Manish will get that money. Now the premium for Manish on Philip was a little bit cheaper, $386 per year. There's a difference in the premium because although they're very similar in age, but the underwriting on their family medical history was a little bit different. That's why Manish, it was more expensive to insure Manish than Philip. It was just a few dollars per year difference. It wasn't a big deal. They were okay with that. Now, in a situation where if Philip graduates, now I'm going to replace the word death with graduation. So if Philip graduates, then Manish will get that $1 million in death benefit tax free, and then Manish will use this money to pay Philip's shares to his estate, meaning his wife, and then Manish will keep all those properties free and clear and will have the cash flow. And then if something happens to Manish, Philip will do the same thing. So Philip will get that $1 million, and then he will take this $1 million, pay Manish's wife, and then have those properties and then use those properties going forward. Now, that was just from family protection, from the buy-sell arrangement that we wanted to create. But let's talk about becoming your banker. Let's talk about Family Bank. So they also started becoming your banker policies in 2016. The total premium between Philip and Manish was $50,000 per year. So, they had some cash flow, which was $20K from passive income. They took that cash flow. They took money from the earned income. So Philip started a policy on Philip for $25,000 per year. Manish started a policy on Manish for $25,000 per year. And those policies, they're going to use it for buying real estate as time progresses. So this was started in 2016. When you have a readily available pool of capital to access, opportunities will come find you. And this is straight from Nelson's book. And they had a lot of opportunities since 2016 all the way to 2022 to use these policies. But I want to talk about what they did in 2022. One of the things that they did on a Philip project, which was Feb 2022, so early this year. It was actually pretty crazy when it comes to properties and how many people are buying properties last year up all the way until early this year. So there was some great opportunities to buy and make some money on the properties, especially for Manish and Philip in this case, because they bought it at a distressed value and then they were able to flip it over to make some profit. So I'm going to walk through that case study. So the property purchase value was $160,000. It's a condo, and the renovation work required was $20,000. It was a basic renovation, nothing crazy. So the total money that they needed was about $180,000 to buy and renovate this condo, and plus a little bit of closing cost. After doing that renovation, the time frame on renovation is like 2 to 3 months. The estimated fair market value that they have from their realtor was between $215,000 and $230,000. So here's what they did. So they had cash values in the system for about $313,000 because they had started policy in 2016. So since then, they've been capitalizing, they've been flowing money to the policy. So by the time 2022 came, they had this much cash value. It's easy to look back and connect the dots. It's not as easy to look in future and see what future is going to provide for us. So when this opportunity came up, that the first thing that they did was they called their infinite banking advisor, and they appreciated the relationship in education and coaching and showing them the way in future, because if they hadn't done anything in 2016, there's no way they could have done what they did in 2022 using their family bank. So the policy loan, which is 90% of cash value, is $281,000, so 90%. Now capital required was $180,000. So this cash value is actually from both policies combined, not just from one. So both policies combined, and the policy loan is from the both policy combined. So capital required was $180,000. So they had more than enough money in the policies to finance the property. So they called the insurance company and then they initiated a policy loan. When they initiated that policy loan, insurance company didn't ask them any question. The only question insurance company asked was, hey, do you want this money electronically deposited into your bank account or you want us to send a check? And that was it. In their case, they decided to get this money electronically deposited. So the money showed up in the bank account between 3 and 7 business days. So they had access to capital. Capital showed up. In this case, insurance company's money. So policy loan is insurance company's money. It did not interrupt the daily cash value growth in their policy. Their cash values between those two policies was increasing every day by $54 a day, which equates to $16.20 a month. Policy loan didn't interrupt that because insurance company still has to fulfill their contractual guarantee, which is cash values must grow every day to match the death benefit by age 100. So that was happening. Now, the policy loan was $180,000. Now, for this year, for this particular company, the policy loan interest is 6.2%, which is at par with what's happening with the banks today. It's crazy. It's crazy what banks have done since the beginning of this year. Insurance companies' interest is being very consistent, 6.2% over the last 3 years. And then as you'll see that the process of becoming a banker is not about the rate. It has nothing to do with rate. It's all about recapturing the interest. So the policy loan interest is 6.2%. So if you take 180,000, multiply by 6.2%, because this is for the year. And the way they calculate interest is on daily basis. So 180 multiplied by 6.2 divided by 365. You can see the formula right here. The daily interest is $30.57. Now, if this is the interest and this is the daily growth, how are they doing so far? They're recapturing the interest charged by the insurance company in the growth of the policy. Remember, the process of becoming a banker, the family bank, the reason why it creates wealth and the reason why it creates value is because it's the only way for us to recapture interest. The value is not in paying interest. The value is not in losing interest. The value is in recapturing interest. So this is the monthly growth in the policy, and this is the monthly interest. They're doing just fine. Using policy loans, they own the condo free and clear. They did all the renovation. They had 100% control on the repayment terms of the loan to the insurance company. Because insurance companies cannot force a policy owner to pay back the loan. Because what insurance companies do is they use the cash values as collateral and they put a lien on the death benefit because they're contractually guaranteeing to pay the death benefit. So if there's any policy loans and interest outstanding when death occurs, they'll just deduct that amount from the death benefit and the family gets the remaining money. So they are their own banker. So they have 100% control on the repayment terms also of the loan. Nobody can dictate anything to them. And that policy loan, which I should have emphasized, is a private arrangement between them and the insurance company. That loan doesn't show up on credit report, TransUnion, or Equifax. It's private arrangement. So when they took that $180,000 to buy the condo and do the renovation work, technically, they own that condo free and clear because the lien for the policy loan is their future dead self, not the condo or their income. Isn't that good? So they have 100% control on the repayment terms of the policy loan, and they chose to service just the interest for now. They could have not serviced anything, but they said, hey, we're going to pay interest only. That's great. Now, here were their options after renovation is complete. So if they actually found the right value for the condo, let's just say based on what the realtor mentioned, they would have flipped it. And then they would have used the proceeds for the condo to pay back policy loans. And then they'll also have additional money as profit. But the other thing that they could have done is, let's just say they couldn't find the right opportunity because there was a lot of distress happening in the economy early this year with interest rates fluctuating. They would have held the property as a short-term rental and they would have delayed flipping. They have full control. Nobody is breathing down their neck on the loan repayment. It's total and absolute control. And when it's total and absolute control, you create more options for yourself. And then it's stress-free way of doing things. Now, let's assume they didn't get the right price for the condo. They would have done short-term rental and delay flipping. So let's analyze the terms on short-term rental. The monthly rent that they could have collected was $1,600 per month. So as interest rates were going up, the rental market also got better. They could have rented that condo for $1,600 per month. Condo fee and property tax is approximately $300 per month. They don't have a mortgage because they financed it all from their own bank. Now, the interest payments to the insurance company is $917 a month on the policy loan. So if they were going to collect $1,600 per month in rent, and out of that, $300 will go towards servicing condo fee and property tax, and $917 will go towards interest on the policy loan. So $1,600 minus $300 minus $917, that would still create a cash flow of $383 a month. They'll still be fine from cash confidence standpoint. And then if an opportunity presents, flip and sell the condo later on. The cash value growth continues with the policy loan outstanding because it's uninterrupted. The monthly cash value growth is $1,620 a month. So total increase in monthly net worth for Manish and Philip, if they chose to go the second route, which is short-term rental, will be $2,000 a month, 2003, because the cash value is increasing by $1,620 plus this net extra cash flow from renting. So the total access to net worth increase every month is their cash value growth plus the rental cash flow. So that's $2,003 a month, $1,600 a month in rental income. And once they flow that through the system, their net worth increases by $2,003 a month. So again, where else can we flow $1,600 and have access to $2,000 a month in positive net worth? That just creates more opportunity. And plus they have the condo, which is owned free and clear. They have cash values increasing every day. They'll get dividends. They have death benefit. Now here's the unseen. More opportunities on the same property. Because they own the condo free and clear, as policy loan didn't show up as a debt. If you have an asset that's owned free and clear, can you go to the bank and say, hey, Mr. Bank, I hear that you guys love collateralizing real estate property. Can you register a HELOC on the property because it's owned free and clear? The answer is yes. The bank can register a HELOC. Now, can they use the HELOC to maybe buy another property? Now they're using bank's money. They use policy loans to buy the first property. And let's just say they held the property for short-term rental and now they're getting cash flow. Now they can register a HELOC on that property and take bank's money and go buy more property while all their cash continues to grow and compound in their policies uninterrupted. They did all this, but not using a dime of their money because their money is in the policy growing every single day. And if they sell the condo, can they pay back policy loans immediately without any penalty? The answer is yes. Can they re-access policy loans again to use for next investment? Answer is yes. So they're just multiplying their wealth. That's why I call this the multiplication. So using becoming a banker, using family bank, you can multiply so quickly. And you don't have to have all the policies. You just need to have the team of people, investors, who can provide all that access to capital. You can be becoming a banker, you can be practicing it. Your JV partner, your financing partner can also be practicing the process of becoming a banker. And together you can create wonders. That's exactly what Manish and Philip did. Now, using the process of becoming a banker, they can own 2 properties, 2 assets, because they could have leveraged to buy the other property as a HELOC against the first property that they bought using policy loans. That would create cash flow. It'll get tax deduction because interest on policy loans can be deducted. If they chose to also get HELOC to buy the other property, that interest is also deducted. And all this time, their money just kept growing uninterrupted, tax-free. So, and if the unlikely happens, let's just say if something happens to Philip or Manish, either of them graduate, they're not going to leave any indebtedness behind because there's more than enough death benefit to pay any outstanding policy loans back to the insurance company. And then they can also use the policies in future because as they're using policies today to buy these properties, the policy values still continue to grow and compound for future uninterrupted. So when they get to a certain stage in life where they want cash confidence, they just won't have confidence in cash from all the real estate that they're going to buy. They're also going to have cash confidence from the policy growth because that still keeps happening. Now, ask yourself this question. Does this process took away any of their options? No, in fact, it created more options for them. Now, with that, I am going to invite my dear colleague and friend, Roman, who's going to walk us through an amazing investment example.
So please meet Corey. Corey is a full-time investor. His age 38. He was exposed to this idea of becoming his own banker. He loved this idea, and also what he loves is he gets really excited about investing and getting a rate of return over 20%. So this is his objective. His objective is to invest his cash, either private lending or any like stock market, whatever deals he finds. He feels super excited about getting a rate of return over 20%. Now, when he came to one of our webinars, our sessions, he was really excited about guarantees that infinite banking can provide and add value to what he's doing. He has read Nelson Nash's book. He loves the idea of becoming his own banker. And he shared with the advisor on our team who was working with him, hey, I really love the idea. I understand the long-term benefits of the infinite banking concept, how it can add value to my business, to my investments. But help me better understand, how can I see short-term benefits? Like, how does it impact me today? How can it bring value to me today in a short term? Because capitalizing this system can take several years. He loves it, but at the same time, he was struggling to wrap his head around the short-term benefits. And his advisor decided to show him this example of how this system can not only benefit him in the long run, but also in a short run. We need to understand that the problem is not the problem. The problem is how we think about the problem. So we are not going to change his objective. We're going to improve the outcome by not focusing on what you buy, but how you go about buying the investment. So everything we do financially is a measure against how someone else is doing. If you're doing good, okay, compared to what? If you're doing not very good, okay, compared to what? So the advisor decided to compare what he's doing financially today to what the infinite banking can do for him. So let us see how we can enhance the same exact transaction for Corey, but just changing one thing for him is the process. Like I mentioned, we're not going to change his objective. We're only going to change one thing, is the process of accomplishing his objective. So what is his objective again? His objective is investing into something that produces at least 20% rate of return. Let's look at what he's doing presently today. He is using either one of two methods. One method is using his own cash. So first off, he needs to save this cash in order to have it. And then when he finds a deal, he uses this cash. The other method, if he doesn't have cash ready, so what he has a principal residence, which has equity, and he can actually borrow from a bank, collateralizing this equity, collateralizing the house, use bank's money, which is OPM, other people's money, right? And he takes a home equity line of credit. The interest rates are now higher than they were before. We all know that. So the interest rate, we're assuming is 6%. So let's look at method one, using his own cash. Let's say he has $20,000 in cash of his own money. For his example, he's taking $20,000, investing in this deal that he found, and he's getting 20% rate of return. Very simple math, very simple arithmetics. His total gain is $4,000. Method two, he uses bank's money, other people's money at 6%, the same exact amount, $20,000. Corey is borrowing from the bank and using for investing. Again, $20,000 invested at 20% rate of return. He makes the same exact profit, but that's gross profit. So we need to subtract the interest he has to pay to the bank, which is 6% times $20,000 is $1,200. It's just interest for the whole year Corey has to pay to the banker. Now the net gain for the whole year is $4,000 minus $1,200 is $2,800 net profit for Corey. Let's agree that either way, if he uses one method, which is cash, or other method, which is borrowing from HELOC, he did pretty good, right? He accomplished his objective. But now let's make it even better, even much better, using something else, using participating dividend-paying whole life insurance policy. And we're not going to change anything, but we're only changing one thing, which is the process. So using the family bank. So using family bank, he is creating a family bank first. He takes $20,000 of his cash. He capitalizes his banking system as annual premium. So he needs to open the policy and put his $20,000 into the policy immediately, because it is a life insurance. It is a whole life insurance based on his age, based on his gender, based on his smoking status. The starting death benefit for male 38 non-smoker is $400,000. Again, this is death benefit, right? So should anything happen to him, if he invests into investment without insurance, then in the case of unthinkable, his family will only get his investment back plus possibly the profit, right? If he opens a policy, should anything happen to Corey, then his family, his beneficiaries will receive a death benefit, which is also tax-free, and they also will get the investments that he invested in. Now, because this policy, participating policy, has something called cash value, his immediate access to cash is $10,333. How do we know this number? Is because we did so many of these policies, we know how they work, and we know that based on $20,000, the cash value in the first month is going to be $10,333. There is something that is contractually guaranteed in the policy, and it is a daily cash growth. And the daily cash growth in his policy is $8 per day. And that's only in the first year. So next year, as Corey is continuing doing what he's doing, his daily cash growth is going to increase. Why? Because he is buying more paid up additions in the policy and he's increasing the target. Remember, the total death benefit and the total cash value in the policy must match when Corey turns 100 years old. That's why the insurance company is giving them this daily growth to match his death benefit. And what is Corey is controlling? He's controlling the total level of the death benefit. He's always increasing it. Immediate loan available from the life insurance company is $9,300. So at any given point, Corey can borrow 90% of cash surrender value. $10,333 times 90% is $9,300. This is the loan that is contractually guaranteed to him. He can borrow from this policy from first month. He doesn't need to wait for years just to access policy loans. So insurance company is charging 6.2%. This particular insurance company charging 6.2% simple interest, which is, there's no minimum payment, but there's only the interest that they're charging. It's being added every day, the interest being added every day to his outstanding loan in the policy. So let's look in detail at this method using Family Bank. Corey takes a policy loan from the insurance company, $9,300, and takes this cash to invest at the same exact opportunity. So now we're talking about using less cash, not $20,000, but only $9,300 to invest at the same opportunity. The gross profit from this investment is $9,300 times 20%, $1,860. Now he has to pay interest to the insurance company because he is not using his cash. He's using insurance company money, which is also other people's money. And insurance company is charging him simple interest. So his cash is sitting in the policy in a family bank, growing every day, uninterrupted compounding. So insurance company is charging 6.2%, which is $576. $9,300 times 20%. That's this profit from the investment minus the interest, $576. His net profit from this investment is going to be $1,284. You may think, Roman, you promised to show us how this is better. So how is $1,284 better than what he is doing presently? Let's look at this snapshot and see what he has achieved doing this through the family bank. Okay, again, method one, cash, $20,000. The profit by investing in 20% is $4,000. So now whose capital is he using to achieve this objective? It's his own cash. He put his cash into the investment. In order to access this cash, what does he need to do? He needs to sell it. He needs to withdraw the investment, right? There's no other way to access this capital. A second method, home equity line of credit. Bank's money, $20,000 invests into the same exact investment. Net profit is $2,800. That's after he had paid the interest to the bank. Whose capital he's using? Bank's capital. Method 3, which is family bank, he's using his capital, $20,000, and he's putting it into his bank. So he's not spending this capital on the investment. And then he borrows from the insurance company, from the policy loan, and the net profit is $1,284. Whose money is he using? He's using insurance company's money. At the same time, his own capital is producing a daily growth of $8. So $8 times 365 days, his growth in the policy has achieved $2,920 for the whole year. By using this method, we need to add the profit from the investment, $1,284, plus his growth in the policy, $2,920. His final outcome is going to be $4,204. So as you can compare, $4,000 is method 1, $2,800 method 2, and $4,204 is the third method. So now you can see what is happening in this policy. He has created a financial tailwind by using his capital he has put it to work, and the financial tailwind is now pushing him forward. So remember, he only invested $9,300. He didn't invest $20,000, but still he has come ahead financially. That's not even the end of the story. When he invests into something that produces income, he has to pay tax, right? When he uses his capital to invest into this investment, he needs to pay taxes for the whole 100% of this investment. Method 2, how much is taxable if he uses bank's money, is $2,800. How much is taxable if he uses insurance company's money to invest? So the taxable amount is only $1,284. So this is what he achieved by using insurance company's money. Not only he made more money in the whole year by using insurance company's money, but he also pays less tax. Nelson Nash said in his book, in the book Becoming Your Own Banker, that not only when you invest, you cannot get a better rate of return investing into anything without first controlling financing function in your life. If you create a financial tailwind, this tailwind will push you forward. It will produce much better result. Not only you need to focus on the rate, because rate it may confuse you. When you focus on the process of achieving the objective, something that is unseen will push you forward, and this method is much better. On this note, I will pass the microphone to my good friend, Vern McCarty. Take it over, my friend.
So the average family, we all have these things that we need to finance throughout our lifetime. We're here to talk about how to enhance your investment returns by implementing the process of becoming your own banker, the infinite banking concept. But we still have to go out and finance cars and appliances and renovate those properties and do all of those things. And everything we do financially begins with the foundation of banking. And when you control the banking function, all those payments that you're currently making that are flowing away are flowing back to you, flowing back to the family system. And when those payments are flowing back to the family system, that means you have more use and control over more capital that you can put to work to grow, but to have access to, so you can take advantage of even more opportunities. So we're always enhancing everything that we're already doing. We're not really changing what you're out to do. You already know how to build wealth. You already know how to invest. We're just enhancing what you're doing by controlling the financing function as it relates to your needs. One of the most common questions we get at this point is, can we connect you with the right person on our team to help you implement this process and take a look at your financial situation to help you get your own family bank set up? And the answer to that question is yes. We have a Becoming Your Own Banker designed for that exact purpose. All you have to do, you can simply text the word schedule to 780-809-4599, and you can reserve a date and time that works for you. I've been implementing this process for a number of years, as have my clients and my colleagues. And I know, and you should know deep down, that you're absolutely capable of becoming your own banker. So let me share with you some of the good value that you're going to receive and some of the tools and resources that are going to be made available to you when you schedule that call to help you become your own banker. So not only are you going to schedule a call and get connected with a authorized infinite banking coach one-on-one to learn more about the process, help you create some additional clarity. They can provide some resources for you so that you can learn more and continue your study. But what's going to happen is when you schedule that call, you're going to get access to a Christmas gift. So there's going to be some additional resources for you to tap into, and we're going to give you access to our robust client portal temporarily for 2 months. So this is a sort of a snapshot of what our client portal looks like. And this is a good welcome video from our friend and colleague, Richard Canfield. See, we have a Becoming Your Own Banker introductory webinar that you can blow through. You can learn more about Ascendant Financial and our team and our mission. But more importantly, there's also a deep dive with FAQs. Look at this, past client coaching sessions, which I'll talk more about later on, but you can actually go back and see our past quarterly coaching client sessions and other webinars and case studies, just to expand your knowledge, learn more about how this process works and how more to apply it to your own situation. We also have some additional resources, special event replays. And this is one that I'm really excited about here. You can see the Family Banking Summit replay. This was a live event that we had in Edmonton back in, I want to say, September. And it was a full day event where we had clients come out. We had people from all across the country join us there, and the entire thing was recorded and edited. So you're going to see live presentations from myself and my colleagues Sarbloh and Jason and Richard Canfield. You're going to get a lot of value from that. So just for setting up that call, we're going to give you access to the client portal. So very easy, just text the word schedule to 780-809-4599. And now here's the follow-up you can expect from our team. We're going to stay in touch with you via email, which you can obviously unsubscribe at any time. You'll receive an invite to schedule a call or schedule a time to meet. And if we don't hear from you first, the right advisor on our team will extend an invitation to find a mutually convenient time to connect so we can help you create some additional clarity. And of course, if you prefer not to meet, you simply just let us know. And as long as you leave happy, that's okay with us. So with that said, what I want to do is I want to share with you some of the feedback that has come from some of our past clients. So this is a note from Alan Antonio. So first of all, Alan is somebody who heard when it says me speak, we're actually referring to the founder of our company, Jason Lowe. He heard Jason speak at one of his presentations, just like this one. And then he had the opportunity to get the book, Becoming Your Own Banker. I don't know if we've mentioned Nelson's book just yet, but that's an amazing resource. You can probably see it behind me, behind my Iron Man fist there, Nelson's book. So Alan read Nelson's book, and then he went through our website. He got his copy, he scheduled a call, and then started to implement the process. And here is what Alan has been able to achieve so far. So you can see here, I'm just going to read the highlights. He says, after 3 years of building our policies, so first of all, I want to point out after 3 years, now we don't have to wait 3 years to access values, but he's actually capitalizing and building his system. So after 3 years of building up his policies, they had already had enough cash value where they could withdraw. By the way, when he says withdrawal, what he actually means is access a policy loan. Yes, you can withdraw value from your policies, but the last thing we want to do is withdraw value because that's going to interrupt the growth. Much like Sarbloh mentioned earlier in that GIC example, if we could leave that capital growing and compounding uninterrupted and borrow against it, we don't interrupt the growth. So that's what Alan's referring to when he says withdraw. Borrow enough money from our policies to pay off our mortgage on our rental properties or rental real estate 13 years early. Who is the one getting paid first? It's the bank. Where is the bulk of that rental income flowing? It's flowing to the bank, and it's being trapped inside the house, and you have to jump through all those hoops to access that money, and you get the scraps that are left over called passive cash flow. Well, in this case, because he was able to access enough capital from his policy system to pay off those rental properties, all of that capital now that the renters are paying, all of that rental income is now flowing back to the family system, and he's able to replenish his pool so we can take advantage of more opportunities. This was a huge accomplishment, knowing that we are now really using IBC, the infinite banking concept, as it was intended. So again, speaking of that money flowing back, when our oldest daughter and son-in-law decided to purchase their first home, we were able to access a policy loan from her policy that we had started. So they started a policy on their own daughter. And also funds from the policies, from existing policies that they had, to buy their home as a cash deal. When you buy things as a cash deal, maybe you have an opportunity to get an additional discount or a better rate, better return on that, right? Because you have ready access to capital. And they had no mortgage from a traditional bank. So the whole entire mortgage is built inside their own policy system. He or she who controls the debt, controls the flow of the money, controls the wealth. So currently they are making payments back to the loan instead of to the bank, thus keeping with the idea of keeping the money in the family. That's what it's all about. Have the money that's already flowing away from the family, circle back and keep it in the family, expanding that pool so you have access to more capital to do more things. So what we want to do is quickly just give you an idea of what we're going to share here, give you some facts. So in this specific example, the family banking goal was to perform a debt recapture. They wanted to eliminate debt. So tired of paying for all those debts and having money flow away from the family and having a lack of control. So what we want you to do is meet the Wilson family. And we have a nice little picture here because client was a chiropractor. And what they wanted was total and absolute control, which is what we've been talking about here today. Control over the financing function and their payments. So let's learn a little bit about the family. Again, the family's objective was to eliminate $420,000 worth of debt in less than 21 years. That's a long time to be making payments. So let's learn a little bit about the client. 47 years young, a male chiropractor. Again, $420,000 worth of consumer debt, including 2 mortgages. So they had 15 different debts total. That's a lot of payments that are leaving the family. And so his banking system was started with a capitalization of $20,000 per year. Again, you're the one who's deciding how much capital you want to put into your system. We're not going to tell you how much capital you need to put into your system. Now, this client wasn't exactly sure how much he wanted to put into his system. So we helped him sort of figure it out. We said, okay, well, how do you get paid? He said, well, I get paid from seeing my patients, and each patient is about $50 per patient rather. And so what we said is, okay, well, how many days do you work? He works about 200 days per year. Actually, that should say, I think it's $100, because what we did was $100 per day times 200 days. So 2 patients a day. We said, can you set that money aside and multiply that by 200 days? That's going to be about $20,000 per year. So that's exactly what he decided to do to capitalize his system at $20,000 per year. And what's interesting is this client didn't actually have the $20,000 to start his system up front. And we said, look, there's nothing wrong with paying monthly premium, but if we're putting capital in a system every month, it's going to take, a while to build up that cash. So he wanted to sort of kickstart his system. He wanted to get it started right away with an annualized premium. And so what he did was he actually accessed $20,000 through a private loan, where he actually accessed $30,000 from a private loan, and he used the first 10 to eliminate some other debts, and he used $20,000 to capitalize his policy system. And then he continued to set aside that $200 or $100 per day for those 200 days. So he was prepared to capitalize his annual premium the following year. So having a clear plan in place for what he wanted to achieve. And speaking of which, here was the family's objectives. Now, what we do is we sit with our clients, we make sure that they're really clear about how the process of becoming your own banker, the infinite banking concept, works. So we focus time and energy on education and making sure you have a clear understanding of how the process works. And once we get to that point, now we want to look at your financial situation. We want to look at your specific objectives. We need to know exactly how you're structured so that we can give you good guidance on how to get your system set up to achieve the objective that you're set up to achieve. So once we did that, here were their objectives. They wanted to become debt-free without working any harder, without taking any additional risk, without changing the cash flow, without losing control over their money, or without leaving the family in debt if the unthinkable were to happen. We had an idea, we created a plan, and now we got to take action to put the system and implement the system. Just like what you're doing in your own wealth, you are learning first, and then you're creating a plan, but we got to take action. If we don't take action, nothing's ever going to happen, right? So that's the idea. You're here today to learn, and then we're going to go ahead and take action on the process. So you can notice here, folks, that obviously I'm only showing a section of the spreadsheet here because there's a lot of moving parts. So what I've had to do is zoom in because it's quite small. So I'm gonna move my screen around. I'm gonna walk you through this exact example. Again, like my colleague Sarbloh mentioned earlier, if you're on a phone, a smart device, you might want to switch it to landscape just so you can see this picture better. Let's take a look at what's going on with the debt situation here. So first things first, you can see the first policy deposit, as I mentioned earlier, is going to be $20,000. Before I go too far on that, I want to just walk through every one of the debts here. So you can see right here, it actually shows the debt number. So this is debt number 1. Who is the creditor? In this case, it's the Home Depot. And they have $2,647 that they owe to Home Depot. You can even see the rate here and the monthly payment and the timeline that they have to pay this debt. So each of the debts is going to show that. Debt number 2, they have the target. That's an old one. Obviously, the target I don't think is here anymore anywhere in Canada. Same thing, a $200 payment in 15 months. So these are on par with each other. We have debt number 3 is a BMO MasterCard. Debt number 4 is CIBC Visa. We have debt number 5. Now, this one's a kind of an interesting one. Wallace Practice. That's actually a private loan for the chiropractor business. They have a TD Bank loan. We have our friends at the Canada Revenue Agency. So we have a little bit of back taxes here. For debt number 7, we have debt number 8. And again, you can see the balance, you can see the rate, and you can see the payment and the scheduled amount of time that's required for each and every one of these debts. This is going to be important as I go through the example because you're going to see what happens to the payments and where those payments flow. Right now, obviously, they're making all these payments on someone else's schedule, and all of that money is flowing away from the family. The whole point, like Sarbloh mentioned earlier, is we want to pay off debt, but we don't want to pay off debt. We want to recapture the debt. We want to recapture the interest within our policy system, because if you think about everything you call an asset, the bank calls a liability. And everything that you call a liability, the bank calls an asset. So if you have a Sears card, which is a debt, there's $12,000 and we have $300 per month flowing away from you, that's a liability to you because it's taking money out of your pocket. But it's an asset to the bank because it's flowing money to the bank. Now, when we recapture that debt within our system and the money flows back, we just are able to shift our liabilities to assets because we become the banker. Okay, so I'm going to scroll down to page number 2 because we've only got through about half of the debts. So let's look at debt number 9. So debt number 9 is a Sears card, and we have debt number 10, which is a Scotiabank loan. So there's a good mix of different types of loans here, amortized loans, that sort of thing. Again, we have another loan with the practice. We have a TD loan, debt number 12. And then this one here is kind of an interesting one. Debt number 3, you can see that says private loan for $30,000. That's the loan that was used to capitalize the policy in just the first year and then to eliminate a couple of other debts, small debts that he had. Debt number 14 is house number 2, so a rental property. And then debt number 15 is house number 1, the primary residence. Okay, so that gives you a kind of an overview of how they're structured. Now let's go through and look what happens, how we implement the process of becoming your own banker for debt recapture purchases, and how we're able to eliminate the debt much faster and recapture the payments that are currently leaving. Now, you should have some context for how the policy is sort of structured and the fact that we can access loans right away because of the great guidance that my teammates gave you earlier. So if we look at what happened is, this is showing the timeline. We have month number 1. So the policy is capitalized with $20,000 per year. And as soon as that policy is capitalized, it immediately gives rise to a policy loan that the client can access without interrupting the daily cash growth or any future dividends. $11,200 is accessible through the policy loan right away. Now we're using insurance company's money. And what does he actually do with this policy loan? So you can see here, total policy loans. What we do is we first eliminate debt number 1, thus freeing up a payment. We eliminate debt number 2, freeing up a payment. We eliminate debt number 3 and recapture all these debts within the banking system, shifting where the debt resides. And then we actually have a little bit of an impact on debt number 4. So now the client has an option. The client is now freed up about $655 a month of payments that were already flowing away. Canadians, we're really good at paying our bills. We're really good at paying everybody else first, and we're never really taught, and we don't adopt that pay yourself first mentality. Meanwhile, we're doing all the work and taking all the risk, and someone else is getting all of the money. So what we're gonna do here is we're gonna shift that context, we're gonna shift that mindset. This client is being very disciplined and very diligent because he was absolutely committed to his objective, which was eliminating that third-party debt and all those payments. So what he chose to do, keep in mind, this is family banking, the infinite banking concept, becoming your own banker. This is an example of what this client chose to do because he is the banker. He's not actually paying back any of the policy loans at this point because he doesn't have to. He gets to choose if and when and how he repays those policy loans. So having said that, what he chose to do was he actually created a separate checking account, and he's now redirecting those payments that were already leaving him. He's collecting and accumulating that cash in someone else's bank, and he's building up that money with the intention of using that to further eliminate his debts. He could be flowing that back to his policy system if he wanted to, but at this point, he's flowing it to somebody else's bank and letting it accumulate there so he can see exactly what's going on and what he's accumulated. Now, keep in mind, as we go through this entire process and months are going by, what is he continuing to do? He's continuing to pay down the balances of other loans. So you can see this one, the Wallace Practice loan, I guess the first loan. We have $1,054 per month at 6% that's being paid back, and it's only going to take 7 months. So he's paying that back, and you can see at that point, he's eliminated that debt. Now, he's not going to go out and finance a new vehicle or have $1,000 a month extra to kind of make it rain and have fun. He's committed to this process. So you can see the amount that he's recapturing after 7 months dramatically increases because he takes that extra $1,054 and he adds it to the $665 that was flowing to his segregated account. Time is going by and his policy system is getting stronger. Remember from the Alan Antonio example that I shared earlier about the family banking, he said after 3 years, they had accumulated enough cash to access enough money to be able to recapture the debt on their rental properties. Well, we're at year 2 now. And what do? We capitalize again. Now you can see in year 1, when he capitalized 20,000, he was able to access 11,200 right away. In year 2, he capitalizes his 20,000. Cash value is growing every single day. We receive annual dividend. So then he's able to access $13,540 out of his policy system. Remember, he was also piling up money in that segregated account. So now between the policy loan and the money that he's recapturing from the payments that he's no longer making to someone else's or to those creditors, he was able to access almost $31,000 through the natural pay down of the payment schedule from the loans that he had. He was able to access that money and completely eliminate debt number 4. Debt number 5 is already gone from the natural pay down. We already talked about that. Then we have debt number 6 that was paid off from the policy loan and the savings from the payments that are no longer leaving. And now we have debt number 7 and debt number 8, all eliminated, and obviously doing damage on debt number 9 from the natural pay down as well. You can see too, because we're able to do a little damage on debt number 9. So now the balance is much lower. And because of how it's structured, that affected the payment. So the payment's no longer 300. And again, being diligent and disciplined with all these additional payments and the savings over here, we're redirecting those payments back to the segregated account. And let's take a look at what's happening here now. So this is a lot of cash flow. This person earns good income, but keep in mind, whatever your situation is, this is the cash that was already leaving this person. So now what they're doing is they're collecting and accumulating that money into the segregated account as their policy values continue to grow, and they continue to pay down their debts naturally from the payment schedules. So now we've made it to page number 2, and we're now able, in month number 25, we are capitalizing the policy now for the 3rd year. And whenever I think about depositing premium in my system, I don't say, oh gosh, I have to pay premium. I get excited. I say I get to pay premium, because the more premium I put into my policy system, the harder my system works, the more it's going to grow year after year after year. The more death benefit I create, the more dividends we receive, the harder the system works. So we put $20,000 into the policy, and now you can see that the amount that they can access, keep in mind, they're not replenishing any of the loans. Okay, just to repeat that. None of those loans are actually being repaid. This is the growth in the policy just from the daily cash growth, the dividends, and then capitalizing the policy yet again. So he puts in 20, he can access 18,235. And because he's being very diligent about putting that payments into his segregated account, he now has built up $43,500 plus our policy loan. So now what is he able to do? He's able to access just shy of 62,000. And now we have debt number 9 eliminated or recaptured, debt number 10. And again, you can see those payments, right? And then we have debt number 11. So gets rid of the loan from the practice. He says goodbye to the TD Bank loan. See you later. You're done taking money out of my pocket. Thank you very much. Debt number 13. So that private loan now has been completely eliminated and recaptured within the system. And the payment that he was making on that is gone. Mortgage number 1 and mortgage number 2, again, being naturally paid down. So he's taken all those payments again, and you can see he has total and absolute control. He's being very diligent. There was no interruptions in these payments that he's making back to his system and collecting this money. But if there was, if something happened now, this is $5,775 per month that was leaving him on a schedule outside of his control. He now has total and absolute control over those payments that he's flowing back to his segregated account and eventually back to his system. If something got interrupted, if life happened, he now has a lot more freedom and flexibility in terms of what he's doing with those payments because he's in control of everything. Now we're doing pretty good here. You can see we now have capitalized the policy the 4th time, and the policy loan that we're able to access is almost 100% of what he put in. So now we've accumulated just north of 69,000 in our segregated account, plus our policy loan. We're able to access $88,310. And now we're starting to do some serious damage on those third-party mortgages. Again, this mortgage payment every single month is being made and it's flowing to someone else's bank. So the balance of that mortgage is $6,980. And you can see after one more month, because of the accumulation of the cash in this segregated account, actually eliminated that mortgage payment. So you can see that the $57.75 that he was putting in has now increased to $65.25. And so now we continue the process. Now this is a very interesting piece that I want you to pay close attention to. You can see in month 49, when we've capitalized the policy now for the 5th time, much like Sarbloh mentioned earlier, you get to decide. You have in this case, a maximum premium of $20,000 per year but that's actually not the required premium. The client's not required to put $20,000 into the policy. He's actually only required to put $8,000 into the policy. And his decision, right? His decision was to reduce the premium in policy number one because he put in $8,000 into the policy and he's now able to access $9,315. Now, if you have a copy of R. Nelson Nash's book, later on, you can go to page 15, the bottom right-hand corner, and it's one of my favorite analogies that Nelson uses. He talks about building live steam. The steam engine changed the world. Well, if you build live steam within your banking system, you're putting a lot of energy into the system in the early years, but eventually that system is going to have hot boiling water that's going to kick out a lot more energy than what you've put into it. And this is exactly what's happening here. The client has capitalized his policy system for a number of years now. And now every time he puts in 8, in this example, he can access 93 right away. Where else can you deposit $8,000 and immediately access 93? This is why we're warehousing our capital in this policy system. Your capital must reside somewhere. It has to sit somewhere, right? Now, what he did, this is what I wanted to point out. Because he's been eliminating all of these debts and he decided to capitalize policy number 2 from some of the cash that he has built up and some of the existing cash flow. He decided to expand his policy system and start policy number 2. Remember, this system, it's a system of policies built over time. Money grows on branches, right? So we add more branches to our banking system and we create more capital. So he's able to access 9315 from policy number 1. Much like the earlier example, when he put in his $20,000 into the policy, immediately he's now able to access 11,190. And because of the diligence that he has here in his checking account, redirecting payments back to that segregated account, he's now able to access a total of just shy of $92,000. And we continue to repeat the process again, being really committed to eliminating the third-party debts. He was able to bring his primary mortgage now down to $54,000 and continue to pay that balance. And now he's redirecting $7,230 per month back to his segregated account. And now you can see here, just after 57 months, his payment now dramatically increases again because we have enough money saved up to eliminate that primary mortgage, and he's redirecting that payment right back to segregated account, and that's okay. And now again, here we are capitalizing the system even further. He continues to put 8,000 into policy number 1, and he continues to be able to access more than what he's putting in. Policy number 2, just like it was engineered to do, is gaining momentum, just like the first policy did. He put in $20,000 and now he can access $17,992. And now because of the savings that he's putting aside in that segregated account and the policy loan values, he can access $62,325. At this point, all of the debts have been eliminated. Now, if he wanted to, couldn't he go and put this money to work somewhere? He could maybe potentially now start working on, hey, you know what? I've worked really hard for the money. I've recaptured all this debt. I now want to put more of my money to work. So I'm going to go ahead and loan this money to somebody else and create additional cash flow that's going to flow back to the family. So now by controlling the family banking function, he has a lot more capital flowing back so he can put a lot more to work to continue to achieve other objectives. That's just an example. That's not what he did per se, but that's just an example to get your minds primed about the power behind controlling the banking function as it relates to your needs. Let's start to think about what actually happened during this whole time. So first of all the debts are eliminated after 57 months versus 252 months is what the debts were supposed to be eliminated in. That's amazing. Now, the total premium that went into his policy system was $108,000. The policy loans that he accessed was $86,480. And the total debt that was recaptured was $420,000. The interest capitalized at the life insurance company. So over the course of that 57 months, remember, there's a loan building up in the policy that he chose not to pay back. And the loan interest that accumulated that he recaptured within his system, because it's being recaptured within the cash value, as he pays that back, he can go back and reaccess that interest because he's the banker. $17,141 recaptured within the policy system. And the interest rate at the time was 7.5%. The interest rate today is 6.2%. So we have $86,420 or $480 of policy loans that were used, plus the interest that was recaptured within the policy system. 103,620 is the total policy loans outstanding at this point. He has $7,640 per month. Remember, that was already leaving him. Your number might be higher, your number might be lower, but money is always leaving, and that's the problem. Payments will never end, but we can change who's receiving the money, who gets access to that money, and who that money is being put to work for. Beginning in month 57, he started to use that money to repay the policy loan and recapture it within his policy system and let the cash value grow every single day. So he was able to pay back the policy loan in full, $103,620 with $76.40 per month in 13 and a half months. He paid back, he recaptured not only the $420,000 worth of debt, but he replenished his pool as it continued to grow and as he continued to capitalize it, accessing more and more capital again to put more money to work if he wanted and be like Alan Antonio, and he could go out and finance his family a mortgage if he wanted and collect and accumulate that payment as well. But after 70 months, he was able to replenish his policy loan and recapture all of that debt. Debt recapture summary: access to family equity. That's the idea, is you're already doing the work. Someone else is getting all the money. And now that equity is being built up in the policy system. And just by changing the behavior, changing the process slightly, we're not changing your objectives, we're just changing the behavior. And by changing the behavior, we're able to accelerate our objectives and collect and accumulate a lot more capital. So here's the recap. This is a visual for what's actually happening. Just think about what we just walked through. Now, by implementing the family banking system, we have our family debt that's obviously in red here and all those monthly payments. And then we have cash value that starts to accumulate right from day one, and it goes up every day, whether you like it or not. I hate to break it to you. Now, this capital is flowing to someone else's bank, and that debt is being controlled by someone else's bank. And what we're doing over time, as we start to implement the debt recapture program and capitalize our system and access policy loans, we're using those policy loans as our cash value increases. We're using those policy loans to eliminate the debt. And when we eliminate the debt, thus our payments go down as well. And we're recapturing those payments within our policy system. And this is a very simple process, but it takes discipline, it takes education, and it takes commitment to make sure that you're taking the actions that you need to take to achieve the objectives you want to achieve. We are responsible to our clients to coach them and to hold them accountable and to educate them, but we can't be responsible for the client. It's called becoming your own banker, the family bank. It's your bank. So you're going to be the one who's responsible for how you operate that bank and how you behave within it, and how you behave is going to determine how your results are produced. Our behavior is far more important than anything the life insurance company is ever going to do. This is what it looks like. Now the debt is all inside the family system and all those payments are coming back. Cash value is rising every day. You have access to more cash to do more things. And so we build positive net worth through eliminating debt using the family bank. This reminds me of one of the major objectives that my family and I were able to achieve early on in building our own system, which is recapturing vehicle financing. So let's go ahead and dive into it. Family banking goals. It's really important to know the goal. And this family's goal was to finance comforts. What are comforts? Well, car financing, vacations. I don't know about you, but our family celebrates this thing called Christmas, and December is not a normal month. We spend a lot of money in December in comparison to a lot of other months. And so that's a family comfort. And we use our policy system to help us offset those costs and recapture some of that. So I want you to meet the Carter family. Again, let's look at a couple of facts about the family. So Dave, the husband, is a project manager. He has a good living at about $120,000 per year. And his wife, Denise, works in retail, and she earns $60,000 per year. And they have their young son, Harry, who's 6 years old. They were introduced to the process of becoming your own banker, the infinite banking concept, in 2020. So fairly recent, at age 40. And their goal was to take over the banking function for car financing. I don't know about you, but each of us have bought cars. And you probably haven't bought your last one. So if we could find a way to finance their vehicles through the family system and recapture those payments, that's, again, going to enhance everything that you're already doing. So their next car purchase, so they're planning ahead. Their next car purchase they knew was coming up in 2022. If you know that you need to use money in the future, wouldn't it make sense to start capitalizing a system and building up that capital today ahead of the need for the use of money? Well, I got news for you. You're never not going to need to use money. So we may as well start capitalizing a system today so we can build up that capital so we can go ahead and use that capital for future financing needs, whether it's cars or any other opportunities. So they also wanted to build wealth for retirement without any additional risk. Well, we know how banks operate. They lend with security rather than invest with risk. And just like Sarbloh mentioned earlier, you are your best advantage. So by implementing this process, we're going to be able to build wealth for retirement or passive income years as well without any additional risk. They also wanted to leave a legacy. They wanted to build life insurance and have family protection. So let's go through some facts. The total family income for husband and wife is $180,000 per year. They saved $20,000 to $20,000 per year, and they had no life insurance. They have $200,000 in cash assets and real estate. So they are building wealth in other ways. They're building up cash, they're being responsible. And if maybe one of my colleagues could, we'll quickly add up. Let me know, how many cars have we purchased so far today in your life? How many cars have you purchased? Why don't I say, what do we got, like 70 cars?
Yeah, let's do that.
Okay, and Henry, just because I have you here, you get to pick. What do you think? What's the average cost of a car? What are we spending on a car right now?
Oh, I think we're probably spending, if we're lucky, 40 grand, 50 grand.
40 grand. Okay, let's go a little conservative and say 40, because I know those costs are going up. So we have $40,000 going toward a car. So that's $2.8 million. Just as a quick example, approximately $2.8 million that's been permanently transferred away from our group just to finance vehicles. And the sad reality of it is most Canadians will spend more money financing vehicles than they'll ever save for passive income time. Just imagine for yourself, not to make you feel bad, but to think about what's possible for the future. Imagine $2.8 million of lost opportunity on all of that money that's been permanently transferred away. We'll never get it back. We'll never be able to put it to work ever again. So we're either paying interest or giving up interest, and we want to recapture that interest in the family system. Here's what the family did. First of all, the policy was started in 2020, and the premium that they chose, not us, and you'll notice something really interesting here. They chose to pay $50,000 or deposit $50,000 as premium for the first 2 years. So again, we know that in this case, the $50,000 is their maximum premium, and they wanted to heavily capitalize early on so that they could achieve the objective that they wanted to achieve. Now, the option was to reduce the premium down to $20,000 after 2 years, but they still have the option to continue to capitalize even further within their system if they want to. So they started the death benefit, or the starting death benefit on the husband was $1 million. What they did for now is they put $500,000 of term life insurance on his spouse so that they have protection for the family, and they have the ability to create more policies in the future. You can actually go from renting insurance, which is term, and you can convert, you have the contractual guarantee to convert your policies down the road, or a chunk of your term insurance down the road, to whole life with no medical evidence. But just an example for next family policy, that's what that means. So let's fast forward a little bit into the future. This is what the family wanted to do. They decided to buy a vehicle. They wanted to buy a Tesla. The price tag was $85,000. God bless them. That's way more than I would ever spend on a vehicle, because I could think of a lot of better things to do with the money. And now they had options to purchase the vehicle. They could pay cash for the vehicle. They could finance the vehicle, or they could do the no finance plan, which is leasing a vehicle. Or now they have a fourth option that most Canadians are simply not aware of. But we're going to make them more and more aware of this process, which is becoming your own banker, the family banking concept. So in 2022, the car financing, the cash value at that time that had been built was over $95,000. And the daily cash growth within the system, of course, each policy is going to have its own daily growth based on your age and the amount of premium you're putting in and the death benefit. So in this case, their policy was growing now at $32 per day, and the capital required to purchase this vehicle was $85,000, and they have more than enough to do that in their policy system now, because they can access 90% of the total cash value. And the death benefit had been grown. Remember those paid up additions? So we started with $1 million. The death benefit now is $1,424,000. So we're further enhancing the protection of the family, estate preservation, legacy, terminal tax liabilities, which Henry will touch base on later. And that's why we're using this system to multitask our dollars. So some important facts of the policy loans. Outstanding policy loan doesn't impact the daily value growth. Again, repetition is our best teacher. We're not interrupting the growth in the cash value. So we're recapturing the interest within the policy growth. It doesn't reduce the death benefit while you're alive. We have a policy loan outstanding and we have a death benefit of $1 million. So we have a loan outstanding, let's say of $85,000. If I graduate today, if I become an angel, that death benefit will wipe out that policy loan and the remaining balance will flow to the family income tax free. So it doesn't have any impact on the death benefit while you're alive, doesn't negatively impact future dividends. So these policy loans are coming out of the policy and the insurance company is going to continue to pay whatever dividend was scheduled to be paid. They're going to pay that dividend at the same rate. It's not going to get impacted because you borrowed money out of the policy. And again, it's a private arrangement between you and the insurance company. You are the one who owns the legally binding contract. The life insurance company merely administers it. And this is a private loan that does not show up on your Equifax or TransUnion. So in 2022, the daily cash growth was $32 per day. And the policy loan was outstanding at $85,000 received within 7 days. And the daily interest on that loan being charged by the life insurance company is $14.43 per day. And how we figure that out is the annual interest rate, 6.2%, multiplied by 85,000, divided by 365 days. So they calculate that interest daily based on the balance. Now, this is key. They are the ones who decided to pay back their policy loan, the payment that otherwise would have went to someone else's bank. They paid back the policy loan at $1,125 per month. They wanted to increase that, decrease that, pause that. That's completely up to them. They're the ones who decided that. They have total and absolute control over their 96-month financing. That's what they chose to do. The monthly cash value growth in the policy at this point was $960 per day. We talk about passive income. Is there any more passive income than going to sleep and waking up every day? And as a result, after 30 days, building $960 in their policy system because it's growing every single day. The monthly loan repayment is $1,125. And the interest on that loan is $432 per month. So that's again, $1,443 times 30 months. So the monthly transaction is $960 of daily cash value growth combined, plus the payment of $1,125 that they're sending back to their own system, minus the interest, because that's being withheld within the and it's being recaptured within the cash value growth. So they actually have access to $1,653 per month. So again, where else can you pay $1,125 and access $1,653?
I just wanted to recap kind of what we've all been going through. From the beginning, we've gone through finance, family comfort, and you've seen some of the examples going through financing investments like flips and expanding the returns that you can get from there. Then we had debt recapture, where you get to eliminate debts by controlling the schedule and not following the schedule that's from someone else. While you're building wealth and enhancing that wealth pool that you're getting, what I'm going to talk about is keeping taxes away from that wealth, not just from while you are building it today, but also when you are transferring it to your next successors. Generational wealth planning. I wanted to start with an exercise. Let's just say you are a business owner. Whether you're a corporate business owner, real estate investors with properties and corporations, I definitely want to make sure you stick through all the way for this segment that I'm going to go through. You have a management team that produced these results for your business. In 2014 to 2015, the revenues were 282.3, the expenses were 280.4, and you had a profit of 1.9. So the next year, the management team has changed, and this is the now new performance that this management team has started with, where revenues are 295.5 and expenses are 296.4, and has lost $1. The year after, revenues are 293.5, expenses 312.5 with a loss of 19. And then the year after, revenues are 313.6, expenses 332.6 with a loss of 19. The year after, it was a loss of 14. The year after, the loss expanded even higher to 39.4. And then the year after that, something really drastically happened where expenses were significantly higher than the revenues that they've collected or earned, and the loss was 327.4. If this was your business, how would you feel about this business and the management team that was running your business? If your expenses are more than your revenues, you have cash, and you're going to end up spending that cash to keep the business alive. But if you don't have any more cash, what do businesses end up doing? They're ending up going to force to increase debt if they want to keep the business. I have some bad news for you. I wanted to tell you that these numbers that we just all went through, they're all real, and they're actually in the billions of dollars. And you're probably wondering who this management team is. It's actually the Canadian government, more specifically, the Liberal government. The federal Liberal government. And I wanted to start with this for you to understand kind of the context of where we are today. And I'm going to talk about specifically diving into the government taxation system. As a CPA/CA who gets to teach a lot of people about taxes, it's not always the most exciting topic, but I think it's really important for you to capture and understand why it's so important about the taxation landscape of where it's going to be. The first part is I just took all of the information you saw earlier and I put it together for you to see again. And the new part that you haven't seen was the debt number. So remember that management team, that was the Harper government. They had a profit of 1.9, and then afterwards they had a debt of 1,024,000,000,000. Now, if I just simply took the debt number and divided by the profit number, that debt would take 538 years just to pay that off. And if we consider that a generation is about 25 to 30-year-olds, so if you have children right now, one generation is about 25 to 38 years. That's gonna take 18 generations. So your grandchildren, the future grandchildren, the children of their children and children of so on and so forth. So that's a lot of children's just to work on paying for the government to collect taxes just to pay that back. If we kind of fast forward and look at to 2021, that debt number ballooned. So that $1 trillion was actually a lifetime of debt that has accumulated over time. And in just the 6 years of time, just 6 years, not lifetime of Canada, over 100 years, okay? The debt went to 1.6 trillion, almost double in 6 years. There's a real big problem when it comes to the amount of debt the government has incurred. And so if we look at that, who's going to pay for it? It's going to be you and your future generations. The children that you are having, they're going to be the ones born into servicing this debt in the future. And if the main source of revenues from the government is taxing citizens, here's what they are already taxing you on. Along the way, you are building your income for your wealth and you're accumulating it. We've talked about accumulating it. And right now, a lot of you may be already accumulating the money in the banks, or maybe you're having it stick into financial real estate because all of you believe that real estate is a great investment. While you are going through that, you need to generate the income to put that money aside somewhere. While the government is taxing you on income. If you have corporations, they're going to tax you on corporate. If you have dividends, they're going to tax you on dividends. They're going to tax you on capital gains, like when you sell your property. They're going to tax you on the interest income that you earn. But that's just not the income. They're also taxing you on when you spend your money. So when you go shopping and you buy something, you have to pay GST and HST. You've got to pay carbon taxes. There's also what's called sin taxes, where if you drink alcohol or you have cigarettes, they're going to charge you for those taxes on consuming that. But let's not forget about the things that you own. The government's going to tax you on things that you own, like luxury vehicle tax. They've introduced a new tax where if you bought a vehicle that's over $100,000, they're going to introduce a tax on it. And if you own real estate, they're going to tax you on the real estate. With this load of debt and the rise in interest costs, how do you think the government is going to pay for it? And I'm just going to leave you to see, they're going to tax you more. And soon, again, I've been a CPA/CA for over 15 years, and there's so many changes in the landscape of taxation that I can't even keep up with all of the taxes that they charge. Soon, they're going to start taxing maybe the air that you breathe. I mean, carbon taxes, climate change, I think you're hearing some of that stuff going on. They're also probably going to tax you on the water that you drink. I just want to take a page from a really great book that we always recommend our clients to read and go through, which is Becoming Your Own Banker from Nelson Nash. And this is from page 29. The government, lawmakers, and bureaucrats who carry out these provisions of lawfully understand that they are dealing with a parasite-host relationship, where the government is not capable of producing anything it gets, all its sustenance from the productive element of society. Government is the parasite, and it lives off of you, the productive taxpayer, who is the host. Now, if the parasite takes all of the produce of the host, everyone, both of the parties are going to die. And so the more income you earn, we live in a Canadian progressive taxation system. And if you don't understand how the taxation system works, is the more income you earn, the higher tax bracket you fall into, the more taxes you pay. And believe me, I want you to think about, are they taxing you enough? I mean, they are already taxing you a lot. And let me just share with you some of the most recent assessments of how much Canadians are being taxed. And as of September 2022, each family, a spouse, earns about $50,000, so a combined income of $100,000, where 43% of the money that I just shared with you is all taxes, all of the spending, all of the income, anything that you are going through. 43% of that is taxes. So 43,000 out of the 100,000 that the family is earning is being paid in taxes, which is more than the housing and food and clothing costs, which is 35.7. So the amount of money that you need to be alive for, 35.7, is a lot less than what you are paying the government. And are the services you're receiving for this higher tax bill, are they improving or worsening? That's the key concept I just want you to take away, is all of the money that you're earning, 43% of that is just going to taxes. Like all of you we've already gone through today as it pertains to family banking. We always customize and build very specific family banking systems to everyone. And so I want you to meet one of my clients, which is the Spectra family. What I enjoyed working with them, they also share with me their wonderful family personal milestones with me. And I'm really lucky to be part of it. One of the things is immediately after attending one of these sessions, they took massive personal action. They reach out to me and to help them get more information about the concepts that we are talking about today. And after which I recommended some videos specific to their goals and objectives, and also recommended them to read the Become Your Own Banker book. Now, when they finish getting educated, reading that book, they immediately booked that meeting with me so that they can learn the concepts of what I've shared with them, but how can I apply it for them specifically? Now, my first impression starting with them is that they were very eager to take control of the flow of money so that it can be capitalized and stored within their own family banking system, because they were just so tired of being taken advantage of. They didn't feel like they were getting ahead. And so that's why I wanted to share and talk to you about generational wealth planning, because they wanted to start to leave some of their wealth behind for their children. But what if it's not just leaving what's behind, but you get to multiply it? So let me tell you about Harvey. Harvey's 47 and he's a mechanical technician, and he earns $150,000 as a self-employed individual. He saves $25,000 per year in an RRSP, and he's accumulated $250,000 to date. Now, Jane is age 45 and she's a teacher, and she earns $100,000 as an employee at an ABC school board, and she's maxed out her TFSA at $81,500 and saves around $25,000. She also has a defined pension plan with the province pension plan that she's contributing $1,000 per month. This is their income situation. Unless everybody has their own similar income, this may be you, this may not be you. That's why we have to have these conversations to sit down to really see where you are in your life journey today. Well, their children are Shane, who's 7, and Grace, who's 5. And as of right now, before meeting with me, they've been saving pretty much $3,500 to take advantage of the government grants that they get to add into our ESP. And there's about $12,000 each for a $24,000 total. So if we look at them together, they also have a couple of real estate properties where they have principal residence, which the cost is they bought it at $500,000. The fair market value today is $600,000. And so if I take what the value has appreciated up to, they have a gain, an unrealized gain of $100,000. And to get that property at the time when they bought it, they got a mortgage of $390,000, which the term, there's about 4 years left. So they put down that down payment, $100,000. So this is their payment that they're making, $1,880.24. They've attended and learned how to they wanted to start the real estate journey. So they started to also have like other ways of trying to build their wealth, which includes getting another property. So this is their second property that they had. Fair market value $600,000. The cost was $200,000. The gain is $400,000. The mortgage is $160,000, and their payment is $716.75. They put in themselves $40,000 into this property. The last property that they have was $80,000 of what they've put in, and then the mortgage that they got was $320,000 for the cost of $400,000. Fair market value is $500,000. So they've gained $100,000 so far, and their payment is $1,436. So that was a lot of information that I went through. So I just wanted to summarize it all for you to see. So you can see from Harvey's RRSP, there's $250,000. The TFSA from Jane is $81,500. The principal residence, the wealth, what has increased to $100,000. The property on the property 1 did very well and increased to $400,000. Property 2 increased to $100,000. So total wealth for that family right now is about $931,500. But one thing I want to now start introducing to you is something related to the TFSA and the principal residence. I mean, for now, these are not taxable. So I'm just taking those out of the equation and showing you that the taxable wealth is $750,000. So let's talk about the goals and objectives that Harvey and Jane have. Now, what I'm going to share with you is their specific goals and objectives. They may not be the same as yours. So these are other things that we take into consideration when we're meeting together. They want to build wealth so that Harvey and Jane have enough money for retirement. They want to remove their exposure to the temperament of the financial markets. Harvey is very concerned since his RSP has been taking a large hit in the last few years. Especially, I would fathom right now, a lot of people who have a lot of money built into RSPs. The market has been very volatile and has impacted the accumulation of their RRSP. The second thing is they also want to leave as much of their wealth behind for their children. But ultimately, what I wanted to share with you is they've had a lot of other objectives that they shared with me, but these were the longer term objectives that I just wanted to kind of carve out for you to kind of see. If you're still wondering why you're not getting ahead, well, let me kind of start the ball rolling. Well, this is kind of what it looks like. This is the people, which is you. This is the government, and this is the banking system. So the banking system and government is actually taking away a majority of your hard-earned money. And it doesn't stop while you are alive. There's one important tax that most people, when they're building their wealth, they don't pay attention to. Because they're so focused on building their wealth, they often neglect it as part of the full picture of things. I don't know about you, but I have a finite time on this planet. I don't know when it is, but what most people forget about is death. And if you think about it, at what percentage would you say that you would one day pass away? How confident will you know that you're going to pass away? Would your passing create tension or stress on your loved ones? Well, from my experience, some families get torn apart fighting for their quote unquote fair share. But guess what? You also have some unwanted family members that want their fair share of your wealth. And no, it's not this family here. It's Uncle Trudeau and Auntie Freeland of the CRA family. And they've written legal rules on basically everything that you own. They're going to get a piece of that. And they're going to send some notice telling you that if the death happened from January 1st to October 31st, they want to be paid by April 30th of the next year. Now, if death happens from November 1st to December 31st, they're going to want to get paid 6 months after, so around May or June. And here's a really important law I want to introduce you to. It's just called the Willie Sutton's Law. Wherever wealth resides, someone is going to try to steal it. And I think I've already shown you who's potentially trying to steal your wealth. So let's talk about the problem. When you become an angel, the government's going to swoop in to ensure that they get their taxes from your wealth. And this is what's lying ahead. Death. We know death is 100% going to happen, so is taxes. And that tax name is called deemed disposition. What does deemed disposition mean? Well, at death, the government is going to consider all of the capital property that you own is going to be considered deemed sold. Even though a transaction hasn't been put in place where you receive the money, they're going to consider it as deemed sold at fair market value. Now, there's some specific clauses that exist for, parents where it can roll over to the spouse tax-free, but on transition to their children, which is called second death, this is where deemed disposition will for sure come into place. If the deemed disposition where the fair market value of the possessions that you own is higher than the cost that you acquired for it, you're going to have to pay taxes on that increase. And the deemed disposition, even when you transfer the property to your children, you're going to need to pay taxes on it. So there's special rules that if husband or wife dies first and transitions it to the next spouse, which is first death, there's options that there are no taxes there. But when that second spouse passes away in the property, you want to leave it behind for your children. Unfortunately, this is the opportunity the government comes in to make you pay taxes for it. And as I talked to you about deemed disposition, you must pay the taxes on it. It's legally written in within about a year, and you have to use money. Even if you have a building, equipment, or anything that's still sitting that has a lot of value, the CRA is not going to accept any substitute for money. They don't care. They want money. They don't want your building. They don't want your car. They don't want anything. They want just the money. That's just a very simplified personal example for the Spectra family, whether they knew it or not. There's a ticking time bomb for them. And I would so confidently say there's probably a ticking time bomb for many of you attending right now. So here's how much they would pay if they both passed away. Let's assume Harvey and Jane worked the full year at death because they're still young. And so likely if they passed away, it would be because of an accident. And so here's how much taxes they would pay on the income that they earned. 150, the taxes owed is 50. So after taxes, $100,000. Jane, 100,000, taxes owed is 27,000. After taxes would be 73,000. If we look at taxes at death, remember, this is all the stuff that they own. So from the stuff that they own, RSP, the taxable value is 250. The property taxable value is $200,000. 600,000 was the fair market value minus the cost is 200. Ultimately, that was the value would be 400, and under the tax rules, half of it is taxable, so it's 200. Property 2, the taxable value is 50,000. And so all of that just kind of following it through. And if we kind of calculate it specifically in the situation on the year of death, the taxes on the deemed disposition, they haven't sold this property, for them would be $229,018. So at death, here's their taxable wealth. Income earned for year of death for them both combined is 250. The taxable wealth on their asset was 750. So their total taxable wealth combined is 1 million. And if their taxable wealth is 1 million, let's take a look at where the money got distributed. Well, 693,982 or 69% went to the family. 31% went to CRA. So if this is the issue now, what would it look like in the future? How do most families who neglected proactive planning pay for this? They use what they already have, what they've accumulated, what their existing wealth is to pay for it. So if we look at the RRSP and the TFSA, that's their liquid cash that they have. The CRA is going to send them the bill and say, here's what needs to be paid. So that's what's going to be remaining left for the family. And what does that look like? The 250 plus the 81,500 subtract the 229 is 102,482. And this is just the Spectra situation. There's a lot of families that I work with and I look at their situation, and the government split could be even higher if all of their wealth was concentrated into the vehicle like an RRSP. And I'm sure you know that your RRSP money that you've put in there is tracked, and that your money didn't even do anything wrong. It got put into these traps. How does it feel along the way while you are generating income to build your wealth? You're getting taxed and taxed and taxed. And that was just today. Imagine, from what I shared with you earlier, looking at the government situation, the amount of debt that they have, the changes of landscape and the amount of things that they can tax you on, the rate that they are taxing you at, could they increase the rate? What would taxes be like in the future? Well, I just wanted to share with you, and this isn't something that I wanted to share, but I want to make sure that you know that there's another problem. When you qualify for mortgages, I'm sure all of you are familiar with qualifying for mortgages. It's based on income, assets, loan to value, specific measures that brokers use. The amount of mortgage funding is based on incomes. So it's using Harvey and Jane with using the property as collateral. Well, what happens when both Harvey and Jane are not here anymore? The bank's mortgage are threatened, and they're going to reassess the loan to see, well, the property is now transferred hands. I don't know if that mortgage is no longer under the original terms that we agreed to. And Shane and Grace are only 7 and 5 respectively with no incomes. So how are they going to service the loan? Banks care about their money, and they're most likely going to demand the mortgage be repaid. Imagine the stress, the family members and everyone involved when Harvey and Jane are no longer here. What stress are they going to feel like when they have to go through that situation? And let's recap. Just remember the information I shared with you about the properties. Well, that was their mortgage that I'm highlighting for you. 390, 160, 320. So a total of 582,000. The banks are going to start screaming back for their money. And if we go, remember that the amount of money that they had after liquidating the RSP TFSAs for tax purposes is 102,482. The family doesn't have enough liquid cash to pay for these mortgages because 102 is less than the 582. The children are going to end up being forced to sell. They're going to lose the one property that Harvey and Jane were building up to cover the mortgages. And remember, one of their objectives was to leave as much of their wealth behind for their children. And so let me ask you, is it achieved? It hasn't been achieved. It's not even about the RSPs you've built or the TFSAs you've built, the properties you've acquired. What about all of the ball games that you've missed, hockey practices, dance or music recitals, all those special moments you've sacrificed for the longer term because you're building something for your future generations? The banks and government built a back door to take away what you've built, the wealth that you've built. So on your journey of building wealth, it seems like you are doing all of the work, but someone is actually getting the fuel to get wealthier more than you. Something's not quite right. And what I want to share with you is these systems that exist want you to keep your money with them so they can keep getting paid and paid and paid and paid. You're constantly getting bombarded. Put your money in the next GIC. We're offering you some 5%, 7%. Lock your money in for 7 years. What do you think they're doing with the money that you are giving to them in the GIC? Or think about this next great investment return that is doing so great, and you're going to keep sending your money over there and over there and over there. Not enough attention is being focused on keeping the money within the family. Most people have this illusion that I'm just going to keep my costs low and get term insurance, so I'm nicely covered for those mortgages. You remember that? But it's important to recognize that it's embedded in the name. Term is temporary. There's nothing wrong with term insurance. It's just that it doesn't maximize its true potential. And you know, the potential of when you need insurance for your death, it gets so expensive. And what happens is most people end up not renewing their term insurance. And they hear all of these wonderful slogans about buy term, invest the difference, and you'll do wonderfully well. But I think you can see now, you can invest the difference, but the government has that back door to get the money afterwards. If I were just to appeal to your logic that death is a permanent problem, why would you use a temporary tool to solve a problem? If you are going to dig something in the ground, you're not going to use a plastic spoon. You're going to use a hard iron shovel. It's a permanent tool that's going to stick with you. Term insurance used properly can be very powerful, but you need permanent insurance to solve a permanent problem. That's why we are talking about the participating whole life insurance policy. And I just wanted to share with you a really wonderful quote from Steve Jobs, who's not here with us anymore. But everything around you that you call life was made up by people that were no smarter than you, and you can change it, you can influence it, and you can build your own things that other people can use. And here's what I wanted to share with you in terms of the solution. You probably know what the solution is, and it's ridiculously simple. Minimize and stop giving your money, your fuel, to the banking system. And by virtue of you building your own private family banking system, using the tool that we're recommending, you also minimize the government's involvement in your wealth. And that way, you're getting everyone out of your life. You want to get, there's so many hands in the pool of your wealth. Well, let's get them out of that pool. Limit them to when you actually need them. In the banking system, it comes with using debit. So deemed disposition taxes at death, unfortunately, can't be avoided because they've been legally designed for you to pay. But when you proactively set up the right plan, you can prevent using your wealth to pay for those legal obligations. So let's help solve Spectra Family's tax situation. First, we're going to start with implementing a properly designed participating whole life insurance policy with a mutual insurance company by an authorized infinite banking practitioner like myself and my other team members here at Ascendant Financial. We are building the Spectra Family banking system. We have to start somewhere. I didn't change their cash flow commitment. Harvey was already saving $25,000 to the RRSP. Jane was already saving $25,000 to the where $18,000 went to the TFSA, $7,000 went to the RESPs. We didn't change anything. The only thing we changed was where they were saving it, the location. Instead of using the banking infrastructure, we are using the private banking system infrastructure. So here's what the family bank looks like. Harvey and Jane were saving $25,000 each. where 25,000, this is one system, one policy, second policy, third policy, fourth policy. So all together, these 4 policies formed their banking system, their family banking system. If you remember, the family wealth was 931.5, and at death, the taxes that were going to be paid were 888,000. Taxes were 306. Mortgages were going to be paid 582. And if we look at, remember, when you start the policy, immediately there's some cash value that's going to be built in which you can access as a policy loan relative to the cash value. And there's also, you've already guaranteed a delivery of money that's going to be coming to you in the form of a tax-free death benefit of $1.1 million. Now, when the Spectra family, Harvey and Jane, graduate and become an angel, well, that death benefit is going to swoop in tax-free, pay off the taxes and mortgages, and that still is going to leave an extra almost $300,000 behind. The family wealth of 931.5 was untouched, and the extra bonus check, $300,000, is still sitting there. And that gets to be added to the family wealth. How is that for increasing the family wealth? I mean, it's sad that Harvey and Jane are no longer with us. If they were, they're still with us, but they have lost, they would have increased the family's wealth. Now, what would it look like for year 2? Remember, cash values and continuing capitalizing the policy, cash value is going to increase. Policy loan that they can tap into to use for things, whatever they want to do, as you've learned today, that's going to increase. Well, the death benefit is also going to increase to 1.3. So how much does the family wealth increase using the same death number? It increases $424,000 at death. So if we look at just summarizing the family banking system, just by implementing the family banking system, there's already that wealth, 931,500. Well, what's going to be taken by the bank in the form of mortgages is 582, taken by the government in the form of deemed disposition tax is 306. Well, on the no family banking side, there's no death benefit insurance. Whatever's in the banking system is what you're generally going to get. So the wealth that's remaining is 43,482. So that wealth is decreased by 888,000. What if on the right side, just by implementing the family banking system, there's $1.1 million as death benefit insurance, tax-free, guaranteed delivery of that money, where the wealth now is $1.2 million. From 931, after settling, paying out the bank, settling, paying out the government, there's still more money behind that gets to accumulate that mountain moving forward. They're paying it forward to their children. And their wealth increases 296,629. And you know what the best part is? With the proactive planning with the right team, the family gets to keep the RRSP. The family gets to keep the TFSA. The family gets to keep property 1, 2, and the principal residence. They don't need to sell anything that they've already built up. They can stress less. I kind of want to now jump into, well, what if this was for corporate business owners or investors who own real estate, or investors in real estate in corporations? Whether you own a holding company or an operating company, I'm just going to include it all in the same umbrella. And unfortunately, the level of complexity for corporations is very high. And so competence in terms of finding the right team is still very, very important. And most importantly, they require an important amount of consideration to evaluate company structures, ownerships, goals, to create that customized, crafted design. And this isn't something that can be templated. Like, you can't just find something with all these programs and say, oh, I'm just going to apply this formula here. It doesn't work that way. There has to be the practitioner and other team members built into your team to support you. They have to have the right capabilities to help your specific situation. I just will mention that if you own a corporation, it's absolutely vital you set up a time so that we can evaluate your specific personal structure. The deemed disposition tax problem at death for a corporation business owner is even worse without the family banking system. And the tax problem could be just as bad as this, where without planning, the government can get 74% of the share, whereas the family gets 26% of the share. This is deemed disposition at death for corporate business owners owning shares. And by implementing the corporate family banking system, this solves multiple problems. The first one is it increases in capital, bypassing the 50% passive income tax rule. We're creating a storage warehouse where most people who have businesses earn a profit. They're like, what am I going to do with the money? I'm going to put it in an investment. I'm going to put it in a GIC. Sure, you can earn $100,000 off that investment, but the government has designed a specific tax rule where those passive income inside a corporation will get taxed at 50%. But by you storing the capital in a properly designed policy like what we do, that bypasses the tax. And what does that mean? Well, just using a quick illustration of a $50,000 deposit versus putting it in a GIC 5% with after taxes. Now, the lines are very thick, but you will see a significant change in terms of the increase where the blue line is the cash value and the purple line is the GIC balance. It's not even comparable. And behind in the orange is that total death benefit, because we don't know when our best before date is, but wouldn't it be amazing that there's something behind knowing that there's going to be a guaranteed delivery of cash in the future? Then there's also a growing pool of capital that gains momentum over time from what you've seen. And let me show you how powerful this momentum is. And we've been so conditioned to seeing this, where the regular banking system at year 30, let's say you've built up 2771725, both of those the same, except on the right side, it's in the form of cash values. The deposit is 50,000. The new balance is 2821725. That's pretty normal. You take 2771, what you have, you add the 50,000 on top. Together, that forms the 2821725. Well, what if it's in a different location, where you've built the extra loyalty to your system that no one can replicate because you took 30 years to build that mountain in a very strategically placed storage warehouse environment for your capital? Well, if you've put it in here, you've put in $50,000, your new cash value would increase. This is for the Spectra system specifically, 2937280. So let's kind of really drive this point home, that after 30 years, the system's mountain has built so high, you put 50,000, the cash value increased an extra 115,555, much more than what you would have put in. And this is what the banking system is giving you. This is not even comparable. What does a loyal branch give you for doing 30 years of service? Maybe you'll give a direct phone call. You'll be able to get their direct number so that they can service you. You'll be lucky if you get a chocolate bar. When IBC is implemented properly in tandem with tax designs, it can change the final outcome of taxes paid to the government on deemed disposition at death for corporate owners. And so death, remember, without planning 74%, the other is 26%. By structuring things properly, reorganizing and putting things in a more strategic place, the family share gets to retain the 88% and the government gets exited out to up to 12, to leaving around 12%. And normally to get money out of a corporation, you pay a salary or dividend personally to get it, and you pay the personal taxes on it, which go up based on the amounts that you receive based on the progressive tax. You've accumulated significant capital in your corporation. How are you going to get it out? At death, there's going to be a significant amount of money that goes obviously coming into the corporation by form of death benefit. But it's also going to give you another bridge where you can exit the money out of the corporation, be able to extract the money out of the corporation without paying salary or dividend and bypassing the personal income tax rules. What does that mean? They can pass on their wealth to their future generations personally on a tax-free basis. And so for corporate owners, while you're alive, you can bypass the 50% income tax rate on passive investments. Have a storage of capital with liquidity that you can tap into. For corporate owners, when you finally graduate, you have the insurance company pay for your deemed disposition responsibility. You have money that can be exited out of the corporation to your children to receive personally, tax-free. You can kickstart your journey to building generational wealth. And family banking is not just a personal or a corporate thing, it's everything.
We want to leave you with this. So I'm going to give you an insight of some of the value that you're going to receive from our team. Creating a family bank obviously needs understanding. So congratulations for being here. You took the big first step, and you're going to continue to educate yourself, get a hold of more resources. And it also requires discipline to implement the idea. Now, I don't need to tell you that because you all already have discipline. You're already wealth geniuses. Now we're just going to enhance whatever it is that you're already doing, because this process can dramatically change your life and it can enhance what your results beyond your fondest dreams. Now, here is what's next. As we mentioned earlier, text the word schedule to 780-809-4599 and reserve your date and time. It doesn't matter where you start in terms of premium. We mentioned that earlier. You're going to be the one who decides. You get to decide where you want to start based on your income level and your access to resources, and we can always add more policies. My teammates all have multiple policies, as do our clients. I presently have 11 policies in our family system and growing. Wherever you decide to start, it's going to feel good. It's going to feel great. Why? Because it's going to work immediately. Capital's going to start building in your policy system right away. You're going to be able to access policy loans to achieve objectives that you otherwise would be spending your own money or borrowing someone else's money to achieve those objectives. So it's immediately going to enhance whatever it is that you're already doing. That all sounds good. I don't want to do this alone. The good news is you can set up your one-on-one conversation with an authorized infinite banking expert. And again, we have a whole team of people here to support you, and a ton of resources and access to tools that are going to help you implement the process. What you're going to get is lifelong mentoring and quarterly coaching sessions that we host that you'll get access to when you book your call. There's about 6 or 8 videos there that are all broken down and edited for you to go through and learn more and see more case studies. You do have options. So the option number 1 is not what you guys are about. I know that. Option number 1 is do nothing, and nothing will change, and you'll continue to work your butt off and give all your money to somebody, to the banks, and someone else will continue to get all your money. Or option number 2 is to schedule your discovery call and take hold of your personal finances and put financial control back into your hands. If you were committed, what would you do? And the question is, are you committed? If you were committed, you take action. Now, I want you to picture a day when financial control is in your hands. Not the banks, definitely not the government, especially after what Henry just shared, and not a risky stock market. When you have finances exactly where you want them to be, you know with certainty that you have the freedom to travel when you want to travel, relax when you want to relax, and serve when you want to serve. Like, isn't that what it's all about? It's all about living life on your terms. That is awesome. Everything is easy when you know the how. See, you're already here because you already know your why. You already know your why. You already know the what. You know what to do to create wealth. You're already investing money. You're already creating cash flow. You're already empowered by learning those processes and strategies to create more passive income and make your money work harder. We're going to help you figure out the how in terms of enhancing what it is that you're already doing to control that financing function. So more and more of that capital is flowing back to you and your family, like our debt recapture example, like the flip example, like Alan Antonio shared in that client testimonial. Have the banking process work for you rather than against you. Isn't that what we've been talking about all day long? This is a great quote from our founder, Jason Lowe. The banking process is working against you when somebody else is controlling the banking function.